The big risk, I think, for markets is that inflation effectively gets stuck.
We are getting inflation prints that are a bit hot.
We know the consumer at some point is going to get squeezed a little bit, so that risk-off component is in there.
You run the fine line of potentially keeping inflation underpinned at a trajectory that's uncomfortable if policy, if psychology doesn't moderate a bit.
This notion that immaculate disinflation is going to continue is something that I find very hard to reconcile with actual data.
This is Bloomberg Surveillance, live from the World Economic Forum in Davos.
So, Bramo, I've got one question. Is it good morning or good afternoon? This matters.
It's good afternoon, I'm sorry to say.
Live from Davos, Switzerland, for our audience worldwide. Good afternoon. Good afternoon. This is Bloomberg Surveillance alongside Lisa Abramowicz. I'm Jonathan Ferro. Together through the week with Annmarie Hordern. In Davos, Switzerland, right now, the eyes of Davos. Bramo on Iowa.
Everyone's just focusing on Donald Trump. Everyone is talking about it behind the scenes. No one really wants to talk about it when you get them alone, when you are in front of a group. But here's the question.
I sense that too.
Yes, 100%. I mean, this is the awkward elephant in the room when you talk in front of a panel. But it's definitely everything that everyone is analyzing and, frankly, unprepared for as they really discuss in private.
AMH, in many ways, Davos started last week on Friday with those comments from the ECB President Christine Lagarde to French TV. That set the tone for conversations through the whole of this week.
Absolutely. And Trump is not just dominating in Iowa in the polls, and then he's going to go on potentially into New Hampshire. He's dominating the conversations here because Europe, even though they've had 4 years to prepare for potentially another Trump 2.0 administration, they're running around almost panicked, is what it feels like at this time.
Well, let's build on that. So President Lagarde of the ECB, let's park the fact we're talking about a central banker commenting on politics. Let's talk about the substance. President Lagarde, Bramo, is essentially saying that the former president, if he becomes the next president, he's going to be a threat to European goals. Climate, NATO, etc., etc. I think we have to reframe that as well. What has Europe done from America recently? What has Europe done for the United States and the White House? And I'm thinking of several key areas. We can talk about China. We can talk about NATO. What happened to military spend across Europe for the last 10 years? Have they delivered, stepped up to the plate? And to your point, they've had 4 years to meet that task.
So it feels like you aren't buying into the message of rebuilding trust, which is the theme of this year's Davos
There isn't
meeting.
any.
Well, but this is the issue, right? Are we seeing a splintering in that order that's really highlighting some of the tensions that are underpinning this particular meeting? That, I think, is what's coming to the fore with some of the anxiety around Trump.
When it comes to NATO, that is going to be top of the conversations because President Zelensky is here and he's making his pitch to business leaders, to world leaders, that they need more support. But if you look at the Warsaw Security Forum that happened a few months ago, a member of the UK Defense said, you're not hitting your 2% target. This is something Trump complained about and lambasted Germany and the others for. And this defense minister said, if we're not hitting our 2% target now, when there's a war in Europe, what else do you need to wake up to these risks?
This is going to be a massive, massive focal point through the week in Davos, Switzerland. Let's start with the price action and go straight to the equity market on the S&P 500. Just a little bit softer to start the week, just a touch negative on the S&P. We're down by about 0.6%. Yield shifting higher. Let's call it 4%, Bramo, on a 10-year.
Yeah, but everyone's trying to push back, and we're hearing from everyone, gosh, stop getting so ahead of your skis. Every single person seems to be saying the same thing. We have an incredible lineup today. First, we're going to start off with Ken Rogoff, who's sitting alongside us, Harvard professor, former IMF chief economist. We're going to be speaking with the head of Moderna, Stephane Bancel, BNY Mellon's Robin Vince, and South African Reserve Bank Governor Lesetja Kganyago. That's all coming up in the next 90 minutes or so, John, as we are here in the beautiful Swiss Alps with bells chiming in the background.
Let's be very clear. We get lucky. I've always felt this way. When you are a European-based anchor working for Bloomberg TV, you have to do this in the freezing cold. The US hours, about midday Swiss time, sun starts to come out. It's actually pretty comfortable, isn't it?
It is right now. Check back with me in an hour and a half, and we can consider that.
Let's kick off the conversation this morning with Ken Rogoff, the Harvard professor and former IMF chief economist. Good morning, Professor.
Hey, good morning.
Or good afternoon.
Good afternoon.
Thank you.
Let's go with good afternoon, and let's talk about what's happening in the global economy. You wrote a fantastic piece in The Guardian just before Christmas. You followed up with a piece in Project Syndicate about the global economy not being out of the woods. Can you just tease some of that out for us just to begin?
Well, there seems to be this consensus here in Davos, but I'd also say more broadly in the States that, you know, it's not going to be as good as 2023, which was surprisingly good, but it's not going to be bad. Inflation's going to come down, soft landing, and there seems to be very little understanding that there's a lot of volatility around that. And if you look at the geopolitical situation, forget about Trump, which we were talking about, but the geopolitical situations, like nothing I've seen in my professional lifetime. I mean, we've gone exactly where we are in Cold War II, but we're in Cold War II, could get to be a hotter Cold War II than it was. And that's very destabilizing. I mean, think what the 70s were like. I mean, part of that, of course, was the breakup of Bretton Woods, but it was also, Iran, geopolitical instability. And so that, I think there's a lot of volatility. It's not all bad. I mean, we could have a good year, but that's really hanging over our head.
As a market participant, what do you do with you don't know what you don't know? You don't know about the volatility. What do you do with, hey, a President Trump coming in 2.0?
Okay, well, they're two separate questions. One's a lot of volatility, and others extreme volatility. So I don't know what to say. But no, I mean, I think volatility probably is not good for risky assets in general. That's what we teach in economics anyway. If there's a chance that the Red Sea gets closed down for 6 months and it adds to inflation and the prices of everything, even if you believe at the other side it might be smooth, AI kicks in early and growth is good, our models say the prices should be lower in that case than that. But I mean, I have no idea how to interpret the market. It seems very sanguine. Even when I look at things like oil prices, I don't get it. I mean, why isn't there more of a premium built in? They, just think this is going to be over in a week? Because at least the political scientists I talk to, say if you look at Ukraine, if you look at what's going on in the Middle East, if it's the same next year, that's like the good outcome, that it's very risky.
Well, so far, oil vessels have been able to get through the Red Sea. A lot of it has been consumer goods, those vessels. Is it hitting someone's bottom line at this point, and that can increase inflation?
Well, I mean, the question's what's next? If it picks up, where's it going? There's certainly, I think, shipping rates have gone way up, right? I mean, that eventually hits something that's, only a component of what you pay, but we're sort of in a volatile stage. It's not that what's happening is going to make inflation blow through the roof. It's sort of what happens next. You can say the same thing about Russia and Ukraine. I mean, I support Ukraine. I've worked with the Ukrainians, but it's not been a good year. I don't know what else to say about it. Well, and, there are risks of something getting worse and how that feeds into markets and how that feeds into prices and everything.
So you don't buy that the sort of lull of 13 million plus barrels of oil per day in the U.S. that are being pumped can really offset all of that geopolitical risk?
Well, it has. I mean, it's been a factor, but up to a point, right? I mean, it depends on, it doesn't offset all the geopolitical risk because it's not just about oil prices. It's about other commodities. It's about investment. It's about many, many global supply chains, many, many things.
We started the program this afternoon, by talking about what was about to happen in the United States and how Europe as a continent would respond to it. What strikes me early on at the World Economic Forum is the absence of a conversation about what on earth Europe is doing for itself, how broken the German growth model is, how it's been totally exposed over the last, let's say, 2 years, energy with Russia, the fractures with China and where the United States stands on that, and maybe the ability or willingness of the United States to provide defense support if we do get the former president back in the White House. What is the European growth model going to be? And what does that discussion sound like to you?
So, I mean, that's a really good question. So a conversation I've had with many Europeans here is, are you planning to do anything for your own defense? Do you realize that even if Biden wins, it's not clear we're going to be able to project defense spending at the same level if there's 2 theaters, much less 3 theaters? You aren't. As far as I understand it, Europe has depleted its stocks of munitions. Russia has built up its war machine. Europe, not really. And that's just one example. And I think you're asking about the European growth model, and especially Germany. And, maybe my perception of watching this for a long time is that Germany was the sick man of Europe. When I was at the IMF, that was the line. That was the headline of The Economist. And
that was the 90s.
That was the 2000s, the early 2000s. And then they reinvented themselves with the reforms that they did that were made a little bit more easier to fire workers and things like that. And then they've undone everything with pensions and everything. I mean, they've gone to a much more French-style model, and they're getting French-style, growth rates. And at the same time, China may not be the export destination that it was. The electric vehicles are coming from China instead of the other ways around. So I mean, I'm a believer in Germany that the East Germany was successful under the Russians. They were the most successful of the Soviet bloc. They will reinvent themselves, but it's not happening in the current administration. And so more broadly in Europe, there's definitely a question of what their growth model is. And a little bit like a deer caught in the headlights here of the Russia on one side, the U.S. probably in retreat from Europe. If it's Trump because he's retreating from everything, if it's Biden because he's trying to spread himself too thin, one way or the other, less in Europe. What are you doing about it? And I just get blank stares.
So they don't have an answer yet. What about the U.S. growth model and the deficit in the United States that they're running? In the next 10 years or so, we'll be paying more on interest payments than our defense bills.
So I believe, and I said this last year when I visited you, that the era where interest rates are zero and everything's free is over. We never should have thought everything was free. Interest rates fell off a cliff after the financial crisis. If you look at the long history of interest rates and real interest rates, as I have, we've had periods where it's been low before, but they end. We've had periods where it's high before, but they end. And I think we're much more on trend now in where interest rates are. If that's the case, then there's a lot more adjusting to do. And there seems to be zero political appetite in Washington. The only time they can kind of get things under control is when there's a divided government and they can't agree on anything and they can't. But I mean, certainly if you get the Democrats sweeping into office in a bigger way than last time, you know what's going to happen. And Trump will run deficits too. I mean, I hate to predict anything he's going to do because the whole problem is he's completely unpredictable. But, there's no appetite for that. And what is the end game to that? The end game is we're going to get these bouts of inflation like we had. And that's not an end in itself because then the bouts of inflation eventually feed into interest rates. And we don't believe that inflation's going back to 2%, and it's a bad cycle. We've seen this movie before.
Based on that, given the fact that everyone's expecting the Fed to cut rates, possibly, if you believe the market, 6 times this year, what do you think is sort of the end place for this rate cutting cycle?
I mean, I think we end up at 3.5% at the very end of this rate cutting cycle, something like that. Long-term rates at 4 to 4 or 5, something like that in the very long run. I think what happens in the next year, the 6 rate cuts, that's a pipe dream if we have a soft landing. That's not happening. We'll get 2 or 3. But there is a chance. I've said the one thing we can probably be sure of is that whatever the consensus is here, and not just here, it's going to be wrong. And if we get a deep recession, and definitely it could happen. How's it going to happen? I don't know, but 25% chance it happens. Well, they will cut rates a lot, not 6 times. They could cut rates, 15 times. I don't know if I'm doing the math right, but a lot of times, if that happens, they're going to drive interest rates to 1%. So that could be built into that 6 rate cuts, possibly.
Ken, this was great. Fantastic to start the week with you, as
Thank
always.
you.
Professor Ken Rogoff of Harvard. I think we can all agree that this forum often turns out to be a highlight reel of bad forecasts. Isn't that what often happens, Lisa?
It often is when everyone comes in and says that it's going to be an amazing year, and then you get a pandemic or everything's going to be terrible and you get a boom year.
The comments on Europe, I think, are absolutely critical for the conversations throughout this week. When the Europeans start to become fearful about the future of US policy, I think the Europeans need to focus on themselves a little bit more about what they're going to be doing next. Up next on this programme, Libby Cantrill of PIMCO is coming up in the next hour to break down the politics. The front runner in the Republican Party is about to run away with it all.
People talk about organic development, which of course is the core. People talk about M&A, but sort of not as much is talked about how much enterprise value gets created by partnering effectively. So that's the spirit with which I think about OpenAI. We just want to have a good commercial partnership, and we want to be investors in the entity, in even the way they're structured. So what I would like is good governance and real stability.
That was Microsoft Chairman and CEO Satya Nadella discussing their latest investment and partnership with OpenAI, the topic of artificial intelligence dominating discussions here at the World Economic Forum. Here in Davos, Switzerland, let's get you a flavour of the price action going into the market open a little bit later on this morning. Equity futures on the S&P 500 pulling back just a touch. We're negative here by 0.5%. Lisa, busy week again, really, for earnings. We hear from Goldman and Morgan Stanley a little bit later.
I love that we're not even mentioning it, even though that really should be front and centre, considering that we did get sort of a bleak outlook going forward from some of the other banks. Do we get something similar from the Morgan Stanley, Goldman Sachs competition?
We'll hear from Sonali Basak a little bit later on this morning. She's going to break things down in front of the Bloomberg terminal over in New York City. A range of events happening on the sidelines of the summit. Always the sidelines,
always.
Right? Never like in the summit, but always the sidelines. A range of events happening on the sidelines of this summit, including this one. Bill Gates, the co-chairman of the Bill and Melinda Gates Foundation, speaking to Francine Lacqua at Bloomberg House in Davos. Let's take a listen.
Which is very high impact, to make sure that that's well spent and that the voters who get behind that feel good about, okay, you're responsible for this result with only, a tiny, tiny portion of your budget. And there are not only humanitarian benefits, stability, economy, environment, huge benefits, because as we make the world healthy, that's where you get the population growth actually gets to a steady state.
So what do you want to focus on in health? And we have some actually pretty incredible gadgets that use also AI to scan, for example, when females are pregnant, whether the baby is okay. But in the next 2 to 3 years, like, what would your priorities be?
Well, I've been amazed at the speed of innovation, and that's even before now we'll use AI tools to design new vaccines and get at the very toughest problems, like getting a great HIV vaccine. This is a device that'll cost $1,000 or less, and we connect it to AI software, and so the cost per delivery is less than $1, where you scan and you see, is there anything about the cord or the amniotic sac that woman is likely going to need a C-section. And so we funded looking at tens of thousands of pregnancies and showed the AI here, this one came out normal, this one came out abnormal. And so it's even better than the best human at doing that prediction. And so, even in rural Africa, you connect this to a cell phone, you do the scan, tells you what you need to know, and that would cut maternal deaths in half if we made it broadly available.
And so what's the challenge in making, and I've seen pictures, I mean, it's incredible. You can really hook it up to an iPad, and you can kind of see, even when there's like, a nurse in a village of like 10 females, what's the challenge in getting that to the right place at scale?
Well, we had to spend hundreds of millions of dollars to invent this, and now it's going through the regulatory process, and that's also very expensive. Sadly, there's no natural market for this. The people who benefit from it have very little money. So the normal market mechanism of, is this a priority for the innovation agenda? Without governments being generous in philanthropy, it just never happens. But it's coming together. I was in Kenya seeing the work, and we'll get it out there. We have partnerships with lots of the ultrasound companies, including Philips, who, if we fund it, they work with us very well.
And this is an HPV single dose. So you basically have a
That was Bloomberg's Francine Lacqua sitting down with Bill Gates. You can watch more of that interview when it's uploaded to Bloomberg.com. Got to be across a range of issues throughout this morning and throughout today. But without doubt, top of the agenda for us, I think, today is what happened overnight in Iowa. Annmarie, just another stunning victory, but widely predicted for the former president.
Widely predicted, Donald Trump coming in #1. What was less predicted was potentially who was going to come in #2. But DeSantis was able to pull it out. He spent so much capital and time there. He did the full Chuck Grassley, 99 counties. Nikki Haley, though, coming in 3rd. What was so interesting, though, and probably very demoralizing for the DeSantis campaign and even the Haley campaign, within 30 minutes, AP, CNN, CBS, all were all ready to call it. for the former president.
Let's get some reaction. We can do that with Terry Haines, the founder of Pangaea Policy. Terry, wonderful to catch up with you, sir. Let's just get your reaction, your first thoughts following what happened overnight.
Hello, everybody, and good morning. Three thoughts, really, four, let me say. Firstly, the Iowa turnout was very much down, and that shouldn't really surprise anybody given the weather, but it was barely half of what the 2016 turnout was. So what's going to happen is these results are going to get sliced and diced, but I think a little bit denigrated, frankly, by the fact that there were so few caucus goers out there, comparatively speaking. Now, with that, how I tend to look at it is Trump versus not Trump, because that's what the street wants to know. And what we come away with, I think, are three things. Half of early primary voters don't want Trump to be the nominee. Secondly, there is a not Trump Republican nomination path that remains viable and probably gets pumped up from New Hampshire a little bit, and then nothing happens for a month. So this race will be very much at loose ends, which is good for challengers. And thirdly, buried in the Des Moines Register polls, the worst news for Trump is that nearly 30% of likely Iowa Republican caucus voters wouldn't vote for him in the general election. So what you're seeing is a looming Republican Party split should Trump become the nominee.
It didn't seem like this was a split, Terry. As you know, we were just talking about how quickly all of the networks called this for Trump. Who's going to be number two? Did we learn that at least, if you do think that this is going to be a split race?
No, well, firstly, I mean, it's a split because you've got 51% of Iowans voting for Trump. So, my view is roughly 50% weren't for. Secondly, no, I don't think we did, because what you got is you got a situation going into New Hampshire where Haley is strong, and then there's going to be a month where there won't be any votes, and not until I think it's the 24th of February in South Carolina does voting resume. DeSantis is already on his way there, so I think it's anybody's game for the opposition at this point. But I do think you're seeing Trump's ceiling here.
Well, when you look at New Hampshire, all the ads Trump is putting out is attacking Nikki Haley because he views her as the most permissive challenger right now, the hardest for him to beat. But with DeSantis coming in second in Iowa, it looks like he's going to stick around now. How difficult is this going to be for the Haley campaign?
Oh, I think it's very difficult for them, and I doubt they're surprised by that. I mean, I doubt they thought they were going to get a clear path regardless. I think the media was burying DeSantis in Iowa, frankly, a lot more than the votes were going to come out. And, but he, net, he got about 2,500 more votes than Haley did in Iowa. So, so both of those are going to look like viable candidates, and continue to run, frankly. And, I think you'll all see them up in Midtown Manhattan very soon, because there's going to be a lot of fundraising that's going to take place over the next couple of weeks.
Terry, let's finish here. Can anything stop the former president?
Can you what, John? I'm sorry?
Can anything stop the former president from running away with this?
Oh, I think so, yeah. If you get a situation where one of these two candidates, either DeSantis or Haley, kind of continues to consolidate votes. This is a very different situation from 2016 when you had 10 not Trump candidates in Iowa as opposed to, effectively 2. If they consolidate around one of those candidates, frankly, and Trump's margins don't get any bigger, you're going to have a protracted fight here. So, this is not over for Trump by any means.
Hey, Terry, thanks for jumping on the phone. Terry Haines there of Pangaea Policy, as the Republican primaries are well and truly underway. Lisa, I know what gets you frustrated. You want to talk about policy, and we're just not talking about policy at all, are we?
I mean, we just heard that from Ken Rogoff. The biggest question about Trump is that nobody knows what he's going to do. He hasn't clarified anything. We've had no debates. We've had no policy prescription. It's all been invective and basically saying, look, they stole the election, so here we are going to have a situation where we have to perhaps reset a bit.
Well, when you're in Europe and Davos, what they're so nervous about is that 10% Trump tariff wall he wants to build. If they thought the tariffs were bad last round, it's going to get a lot worse.
More coverage of US politics throughout this morning. Up next on the programme, Lisa has questions. Everyone's sick. Stephane Bancel, the Moderna CEO, up next. We're live from Davos, Switzerland at the World Economic Forum. Your price action this afternoon, this morning, depending on which part of the world you're in right now, looks like this. In the equity market on the S&P 500, equity futures shaping up as follows. Negative by 0.5%. On the NASDAQ, we're down by about 0.6. Earnings season well underway. You'll hear from Goldman Sachs and Morgan Stanley in the next 24 hours. And then early February, in fact, at the end of this month, Lisa, we start to talk about tech as well.
Which is really the main theme here, I would say, in Davos, artificial intelligence, which everyone basically says, we don't know what's going to happen, but let's all talk about it and angst about it, because that seems to be the theme right now.
Another theme is US debt. Budget deficits in America, trying to confront them. Is anyone going to confront them? Let's check out the bond market. 2-year, 10-year, 30-year. Treasuries look a little something like this. On a 10-year, yields are higher by, let's call it 6 or 7 basis points here, Lisa, just north of 4%. What's unusual is that we have got a consensus, surprise, surprise, shock, in Davos, Switzerland, but it's on Federal Reserve interest rates. The pipe dream of a soft landing and 6 rate cuts this year, the words of Ken Rogoff, Harvard professor, in the last 30 minutes.
Basically saying there is no way they're going to get more than 2 rate cuts if we do get a soft landing. And we've heard pushback after pushback by Fed official. IMF chief economist came out earlier today. The market's not buying it.
You do wonder where that leaves the President of the United States.
They're banking on a soft landing.
Big time.
They've all said it. Treasury Secretary Yellen, Joe Biden, and the economy is the #1 issue, John, when it comes to American voters.
Let's turn to foreign exchange just briefly and have a quick look at the euro. Lisa can guess where this is. The euro against the dollar, typically around 109.50 and not a million miles away this morning. Bramo?
That's basically where we're at right now. A real question. You mentioned Europe and what their growth is going to be.
Huge.
And I don't see that being priced into the euro. Kit Juice was talking about that this morning in a note.
Data comes out of Europe. Data's bad. Where does that leave the ECB? Never mind having a single mandate to focus on inflation. The growth model in Europe is broken. It's shocking to me that every time we sit here in Europe, there isn't a bigger conversation about what the growth model is going to look like. Let's think about every single issue we talk about at the moment. EVs. Yeah. Where's Europe on EVs? AI. Where's Europe on AI? They want to regulate it, sure. We all understand that. But who's driving it?
Which is the reason why a lot of people are just shrugging when you've got ECB officials who've come out one after another saying, we're not even going to cut rates this year. And the market's basically laughing at them because what is the growth prospect to really get them out of the situation?
John, what you have said about Europe is right. They've outsourced energy to Russia. That blew up in their faces. They outsourced their economy to China. And they're still trying to do almost different plans, depending on who you talk to, whether it's Macron or Scholz. And they've outsourced their defense to the United States of America.
With the President of the United States seemingly leaning into this sort of multilateral approach, the next president might not be leaning in the same direction. Under surveillance this morning, Donald Trump moving a step closer to a rematch with Joe Biden. Trump winning 51% of the vote in the Iowa caucus, with Ron DeSantis a distant second and Nikki Haley third. The former president has another chance to tighten his grip on the Republican nomination at the New Hampshire primary next week. Annmarie, is the result, the outcome, going to be any different?
Well, potentially it could be, only because New Hampshire, you do have Nikki Haley really trailing Trump's tail there. And you can see all his ad spending is against Haley. But poll after poll continues to show Trump just is dominating the Republican Party. He's almost an incumbent within this primary race of Republicans.
Which is the reason why it's shocking that people are as shocked as they are to see it kind of facing in their, you know, to be in their face. And to me, what's funny is that no one really wanted to think about it, so they didn't think about it. And then all of a sudden, this is sort of the first reality shock, and that even if it's no surprise, everybody knew this was going to be the outcome, it still is sort of igniting a conversation that everyone had been loath to have for so long.
We talked about how annoyed you might be about the fact that we're not really discussing policy. We need to talk about bank policy and regulation. You could see a real shift in approach if we get a change in administration. A little bit later this morning, big bank earnings continue, with Morgan Stanley and Goldman expected in around about an hour. Bloomberg Intelligence expecting Goldman's net revenue to return to growth after 7 straight quarters of declines. For Morgan Stanley, it will be the first earnings call for new CEO Ted Pick. And Lisa, you'll be leading that conversation a little bit later this week.
You know, this is the key question for someone coming into the helm after a storied career of James Gorman. How do you then shape a narrative where Morgan Stanley essentially won against Goldman Sachs? Now he has it to lose, right? There's this question of, okay, well, then how does he sort of follow on at a time where a lot of people are warning of sort of a slow grind in the economy and for banks this year?
So perhaps unfairly, but accurately, I described Davos as a highlight reel of bad forecasts. So last year, the forecast was US economic growth, we could dip into recession, China's going to reopen, it's going to be fantastic. Flip it on its head. Here we are 12 months later. We're talking about this. More stimulus on the way for China's economy. Senior policymakers considering $139 billion of new debt issuance under a so-called special sovereign bond plan. That's according to Bloomberg reporting. The sale would be the fourth in the past 26 years and would fund projects related to food, energy, supply chains and, Lisa, urbanisation.
This comes as China sends the largest delegation to Davos since 2017. There is a real feeling that the concern about slow growth in China is superseding a lot of the ideological rhetoric that we've heard from Xi Jinping. Whether they follow through on that remains to be seen. People don't know. What would it take for companies, international companies, to get confidence to go back into China right now?
Well, I think it would take what's going on geopolitically for international companies to want to go on. And also, depending on who the next president is, Joe Biden didn't pivot away from what the former president did when it came to tariffs and even doubled down. More export controls when it comes to China.
Let's get to the next conversation with Stephane Bancel, the CEO of Moderna, alongside us on Bloomberg Surveillance. Good afternoon to you, Stephane.
Good afternoon.
Rebuilding trust is the title of this forum. We know for your industry, you need to rebuild some trust with the vaccine industry. How do we go about doing that?
I think we go using the data and the facts and trying to work with people who need it most. If you think about it, what makes me really sad in those days is you have a lot of people getting a flu shot to be protected, especially the elderly, which is great. And then some of them refuse to take a COVID shot. When you look at the data this season, you have 5 to 7 times more people being hospitalized of COVID in a senior group than flu. So we have a lot of work to do across the governments, industry, to go back to the fact that science is science. And if you look at our lives today, I mean, you guys talked about AI, the airplanes. I mean, all our lives is based on science. And I think we just need to work together to make sure that people have access to the data and the facts, because there's been so much misinformation, and we need to get back to...
Stephane, can I jump in?
Sure.
Science, as you know, as a scientist, is a process of discovery. I think often we talk about it as if it's definitive, that we've found something out and that's the rule now. And I think for the general public, listening to the scientists over the last 3 years, I think what they've heard is this is the science, and then the follow-up 6 months later is we got it wrong, we learned something new. How do we change that?
I think that was one of the challenges in some countries where people were a bit too dogmatic, trying to communicate in very simple terms to the public, because you had to communicate very complex science to the public, and sometimes we're a bit too in the absolute, whereas we were learning in real time about this virus. Nobody had seen this virus before. The pace at which, for example, it mutated surprised everybody. I remember when it started to, Omicron started to emerge in November 2 years ago, being shocked with my team looking at the sequence and saying, it changed so much, and turning to my top scientists saying, when did you expect this would happen? They're like, maybe a year or two from now. So a lot of humility in terms of the science and about also communicating. I remember early in the pandemic, hearing public health officials saying, you don't need to wear a mask. And watching this on TV and saying, how can you say that? Because it's a respiratory virus. Of course you need to wear a mask. I understand what they were trying to do, which is to protect the supply for people working in hospitals.
Right.
But by making such a blank statement, you lose credibility.
To that point, a lot of people here are sick. A lot of people have canceled. Are you wearing a mask?
No.
Okay, so
because I'm vaccinated.
Okay, but a lot of people are frustrated that when you get vaccinated, you still get sick, just less sick. Are we getting closer to getting vaccinated and then not getting the flu, or not getting COVID, or not getting RSV?
So it depends on our immune system is what it is as humans. We cannot change that, or we don't know yet how to change the immune system. And so the question is, when do you get infected versus when you got the vaccine? Which is, if it's many, many more separations, you're going to get protected against long COVID. If you think about it, the piece we should all think about those tools, vaccines, is to protect you against very bad outcome, like insurance, And so for the elderly, you don't want them to get hospitalized. For people our age, is not getting long COVID. I didn't get my COVID shot because I'm scared of being hospitalized. I'm 52, I'm pretty healthy. But what I don't want to have is long COVID. I had coworkers who got long COVID, and it's really, really bad. And those were healthy people in their mid-40s that spent 6 months without being able to be a father or a mother, a coworker. And this is the type of things we need to prevent.
We're trying to move into the post-COVID era. We're trying. I don't know if we have, but we're trying really hard.
Yeah.
And I'm wondering from your vantage point how you get Moderna to be a company other than a vaccine company, which isn't as profitable, isn't as lucrative as other drugs that are reimbursed at higher rates.
So I want to challenge that a little bit. I think innovative vaccine is a very good business. What you don't want to be is in a vaccine where you have 50 me toos, and the price, of course, is very, very low. Look at what Merck has done with HPV. It's a $6 billion franchise. They own the franchise around the world, or what GSK has done with Shingrix. And so I think it's highly possible. And if you look at the Moderna pipeline, a lot of innovation coming, including with this year. So we're going to see our second product launch this year, where when it happens, will make us really a platform company, because it will be the second product using exactly the same chemistry, the same technology. And then we have products like CMV that we should have a phase 3 this year. CMV is #1 cause of birth defect in the developed world, so in the UK, in the US, in Europe. And there's no thing today. There's no vaccine that exists. Everybody has tried. They all broke their teeth on trying to make a CMV vaccine. And so this, I think, is very lucrative because those viruses are not going away. So if you think about the discounted cash flows over many, many decades, I mean, those are very interesting businesses. And then if you think about what we're doing in cancer, just before Christmas, we announced 50% reduction of death or recurrence of disease versus the best drug on the market in a clinical study for skin cancer. And we believe this can be extended to lung. There's a phase 3 ongoing, and other cancers. And then genetic disease. This is another area that we've not talked a lot about recently, but we have very profound clinical impact in kids that have basically wrong DNA from mom and dad, to which we provide the instruction through mRNA to give them the protein that we make every day without thinking about it, instead of like giving a liver transplant. So you're not changing a whole organ for one protein missing. And that's what's happening for Moderna. Is you're going to see this year an amazing number of clinical data coming out of new product launches as we move into the post-COVID world.
Let's talk about one launch. You've launched an RSV vaccine.
We're going to launch soon. We've not launched yet.
OK. In the process of doing so. You will be third to market, I believe. How do you plan to compete?
So a few things. First, we have the best profile. The two other vaccines that are on the market are very complicated to prepare. As you know, there's a big shortage of pharmacists and technicians in pharmacy. Even some pharmacies in the US had people on strike. And so our product is very simple. You take it out of the fridge and you inject it. It's in a pre-filled syringe versus the many steps of preparation and potential medical errors in the two existing products. Another piece that people have said, they'll say, oh, Moderna, you're a small company. You can't compete with established large players. Look what we did to market share of COVID in the US this fall. We increased our market share tremendously despite having a much smaller team than the other mRNA player, because we use a lot of technology. We also get the facts in front of the medical professional, which is our vaccine, because of its higher dose, has shown time and time again through big studies having less hospitalization than the other mRNA vaccine. And so our science and the ease of use of our product is what's going to drive us to be competitive.
So distribution. Is it going to be at CVS? Will it be carried by places like CVS?
Oh, it's going to be available, of course, in retail pharmacy. One of the things that COVID has done is to accelerate the role of pharmacy in terms of vaccination. Flu, COVID, 70% of COVID season to date has been delivered in pharmacies, which actually take capacity out and provide the doctors to be able to do things that are more specialized in terms of work. So I think it's good for patients.
Stephane, this was great. It's good to catch up. It's good to see you. Stephane Bancel there of Moderna. Elisa, the title of this forum, we'll keep revisiting it. It's Rebuilding Trust. There's an industry that's trying to rebuild trust.
And it goes deep, right? There's sort of this, we were talking about offline, this sort of tribal feel and a very political feel around vaccines, partly because of some of the mandates and the changing understanding of the drug. But, you know, how do you get people to take something if they cannot be hospitalized as a result with science that's evolving in real time?
Well, I think Stephane just convinced us all. If we don't want long COVID, we need to get those vaccines. But to the politicalization of this, and to Stephane's point, when you have an official that comes to the podium and says, oh, you don't need to wear masks because they're just trying to hoard them for the medical profession, you just have to be honest with people, or you lose trust and then you lose credibility.
You lose credibility, and I would argue they've lost credibility over the last few years. Do you remember when crypto was like the rebel child of finance, and now it's just kind of like institutional?
It's been institutional at Davos for a while.
I'm not going to say it's boring. I'm just going to say it's institutional. That's coming up next. This is Bloomberg.
40% of the G20 countries have crypto regulation. You see that in Japan, you see that in Singapore, you see that in many countries around the world, big financial centers. And so we're optimistic the U.S. jumps into this and gets this right, but we're definitely seeing a lot of thoughtful regulation in many countries.
That was the Coinbase CFO, Lesetja, speaking to Francine Lacqua on the optimism of crypto as Bitcoin gained ETF approval just last week in the United States. Alongside Lisa Abramowicz, I'm Jonathan Ferro. This is Bloomberg Surveillance Live from Davos, Switzerland at the World Economic Forum. Just to check in on the price action, it's not just about Davos this week, of course. We need to talk about earnings through this morning from Goldman Sachs and Morgan Stanley. Equities pulling back just a little bit here, Lisa. We're down about 0.5%. I've said it a few times over the last week or so. The highlight of earnings season for me, and I think for many others as well, will be Apple in early February, given the two downgrades we saw in early January following a massive year of gains for that stock.
Well, what is it? 30% of the S&P 500 at market cap? These companies, I mean, at a certain point, they are the index. So you could talk about banks as some sort of bellwether for the U.S. economy. But ultimately, it resides in this question of whether tech can continue to rescue the U.S. economy from some sort of sluggish growth and just sort of sluggish performance in the rest of the stocks.
You know, I think we talked about a little bit earlier on. We did a series of panels at the World Economic Forum a little bit earlier on this morning about peak private markets. You think about what's changed more recently, just this fear that public markets have been reduced to, say, one region, 7 names. And that ultimately, if you want alpha diversification, you've got to go elsewhere. When we talked to the bankers this week, ask them about regulation and the prospect of higher capital rules, and you're going to see a lot of unhappy faces. You ask the asset managers in private credit, you're going to see a lot of happy faces. Regulation this year is a big deal.
That's been the issue, and frankly, the complaint from a lot of the big banks is that private capital is stealing our lunch. They're capturing everything that we can't do because we can't really invest in the same way without holding a whole lot of capital, which is interesting and something I want to ask Ted Pick of Morgan Stanley about private markets. How do you get in as a big bank, regulated as a bank, but be profitable in the same way as private equity?
Ted Pick of Morgan Stanley later on this week. Brian Moynihan of Bank of America as well. So we'll be catching up with the whole financial sector through this morning and through the week. Are the regulations getting better for the world of crypto? Let's have that conversation right now with Jeremy Allaire, the co-founder and CEO of Circle. Jeremy, good afternoon.
Thank you. Great to be here.
We mentioned in the previous segment, and I don't know if you heard this, so I'll repeat it again. Do you remember when crypto and everything you do was like the rebel child of finance, and now it just feels like institutional? Is that a good thing?
Well, I do think it's a good thing in the sense that, you know, when we set out to do what we're doing over 10 years ago, I think the vision was that you could integrate the traditional financial system with this new technology, and that this new technology could really change the possibilities for how money moved in the world and how different types of financial services could work. And the only way to do that is by connecting them together, doing it in a regulatory compliant way. There's obviously different dimensions of this industry, and so there's certainly a part of the industry that, you know, seeks to have nothing to do with the traditional financial industry or governments or anything like that. And I think the mainstream phase of this is one in which you've brought together, you know, regulation, traditional finance, and, you know, blockchain technology, and, you know, leading crypto players that can kind of connect those worlds together.
Talking about institutionalization, Bitcoin ETF, we just saw it approved. You were just talking about that. Does that make your job easier or harder as you try to get people to adapt to stable coins, which are different when everyone associates crypto with Bitcoin?
It makes it easier. And I think a couple ways to think about that. The first is that, you know, this is a watershed moment. You have signaling from, you know, all the major participants in the financial sector, the exchanges, the biggest trading houses, you know, the biggest asset managers, that they're moving into this space, and that's a kind of validation. And I think to the average, whether it be person or institution or large internet firm, this sends a signal that this is now connecting to the global financial system. And I think people will begin to say, okay, what are the killer apps of this? What are the killer technologies of this? And there's no question that the killer app of blockchains today are stablecoins. And so I think it leads more people into that path of discovery, and it leads you know, more people to begin actively trying to apply this technology. And so that's really a very positive for us.
So is this the perfect moment to do an initial public offering?
I mean, I can't comment, obviously, on any kind of regulatory filings. We've always said we want to build one of the most trusted, transparent, compliant companies in the world, and ultimately becoming a U.S.-listed public company is part of that strategy. But I can't make any comments about any specific filings.
Is there a sense, though, of a timeline and evaluation that you would be targeting?
Again, I can't make any comments.
I can sense the hesitancy, so how about we frame it a third way? You tried to go public before. What's changed in the last year or so between then and now? How different is your company? What kind of position are you in versus previously?
Well, I can certainly talk about the evolution of the space and the company as well. I think, our business, the USDC business, went through a period of very significant growth, and we've gone through a lot of growth in terms of its economic potential for us. And we just came out this week with the State of the USDC Economy report for 2024, and it's an incredible story about hugely increasing types of applications of USDC in international applications, major fintech and payments and financial companies that are connecting and using this. And so we're seeing this tremendous international expansion and progress, and we're seeing that USDC is in fact the least speculatively used digital currency that's out there. And so that's really tremendous progress, and that progress has happened significantly over the past couple of years, despite the turmoil.
Well, but to talk about the turmoil, I mean, how important is it? You have talked about regulation, the importance of getting regulation. How important is it to have things like audits to understand just how much capital people have put behind coins that are supposed to be pegged to, say, the dollar?
It's critical, and that's why from the very inception we always provided, public accounting firms attestations to the reserves. And in fact, today, in partnership with BlackRock, the Circle Reserve Fund is in fact an SEC registered fund structure that has daily transparency into all of the instruments underlying about 90% of the USDC reserve. So there is that transparency, and there is that kind of more and more protections around that. That's being codified into laws around the world, meaning regulators everywhere are saying you have to have these reserves, you have to have these audits, you have to have the relevant kind of anti-money laundering, all of those things. So I think the model we've developed is also becoming a norm around the world with regulators.
Jeremy, appreciate the update. And to those of you at home following this conversation, if you want the cheat guide, if you bump into Jeremy in Davos, Switzerland, don't ask about the IPO, ask about the party. Because crypto parties, people are talking about no money in crypto. The crypto parties are where it's at this week, big time.
It's always, it's been that way for a couple of years.
I think there's still money circulating.
Exactly. You could get the sense that there still is quite a bit of muscle and DJs and all sorts of other things.
Yeah, just a bit.
Question of cool, too.
You've got to sort out the invites, Bramo. Jeremy, this was great. It's good to see you.
Cheers.
Jeremy Allaire there of Circle. Plenty going on at the World Economic Forum. Here's another conversation for you. Ruth Porat, the Alphabet CFO, speaking with David Rubenstein of the Carlyle Group at Bloomberg House in Davos.
When the great meltdown, the great financial crisis of 07-08 occurred, and it is said that people thought that Morgan Stanley and Goldman Sachs and everybody else was going to go under. Were you living through that, and did you actually think Morgan Stanley was going to make it at that time?
There were days I did not. It was bad. So I was running financial institutions banking at the time, and probably the most meaningful part of my career was when Hank Paulson called and said, I need advice, I need some bankers here. And so I went to and led a team that worked on Fannie Freddie and then AIG, and those were very, very challenging days. And coming out of it, we did Fannie Freddie, and then we did AIG, put them into conservatorship. And I got to Morgan Stanley. John Mack was CEO at the time, and he said, "Okay, you're in charge of liquidity. Figure out liquidity." And of course, days before what very much was running out of liquidity, there was no way to get liquidity. In fact, one day we were trying to figure out what to do, and I was on the trading floor, and I'm like, can we maybe sell the chairs? They were Herman Miller chairs. I thought that might be a solution. That was supposed to be funny, but it was actually really scary at the time. So no, it was hard, but we did this whole series of different teams, and it worked. MUFG came in. They were an incredible partner. The government came in. We became a Fed-regulated bank, but there were some very scary times and a lot of important lessons.
One of the big challenges was that Mitsubishi agreed to invest at, let's say, $23
That was
a share.
Alphabet CFO Ruth Porat speaking with David Rubenstein at the Bloomberg House event in Davos. You can watch more of that conversation when we upload it to Bloomberg.com, and for Bloomberg Terminal users, you can find that at Live Go. AI, big feature this week.
Yeah, what are they saying definitively, though, other than we want to own it? We want to capitalize on it. It's going to change the world. Stay tuned.
I spoke to the NYSE president this morning about confronting an era of misinformation and how difficult that's going to be for capital markets. We'll catch up with Lynn Martin later this week. Up next on the programme, Libby Cantrill of PIMCO on Donald Trump's big win in Iowa.
A big risk, I think, for markets is that inflation effectively gets stuck.
We are getting inflation prints that are a bit hot.
We know the consumer at some point is going to get squeezed a little bit, so that risk-off component is in there.
You run the fine line of potentially keeping inflation underpinned at a trajectory that's uncomfortable if policy, if psychology doesn't moderate a bit.
This notion that immaculate disinflation is going to continue is something that I find very hard to reconcile with actual data.
This is Bloomberg Surveillance, live from the World Economic Forum in Davos.
Lisa made the rules. It is good afternoon. It is not good morning. Live from Davos, Switzerland for our audience worldwide. Good afternoon, good afternoon. This is Bloomberg Surveillance alongside Lisa Abramowicz. I'm Jonathan Ferro, together this week with Annmarie Hordern. In your equity market on the S&P 500, equity futures are slightly negative. It is hour 2 of our coverage on day 1 of the World Economic Forum in Davos, Switzerland. And what an hour behind us already. Lisa, we've got to reflect on Ken Rogoff, the Harvard professor, calling a soft landing and 6 rate cuts a pipe dream for this market.
And maybe it reflects a little bit of the nervousness that you're feeling percolate into markets. When I say little, I really mean little. But you've heard so many different officials push back on the market's pricing, and the market keeps saying, essentially, implying, well, we've gotten it right and you've gotten it wrong, so let's go. But really, to me, that's what sticks out given the over-indebted kind of structure that we have.
If it's a pipe dream for financial markets, AMH, we've got to talk about it. What on earth does it mean for this White House going into an election campaign this year?
An absolute headache, because this is their base case. How many times have we seen Treasury Secretary Janet Yellen come out and say, it looks like we are going to have a soft landing? The President of the United States himself thinks that. So that was setting them up for potentially this decent timeline of having November, because the most important issue remains the economy. And, you know, that just plays into how Trump won in such a massive way last night in Iowa.
Well, the big thing we woke up to this morning wasn't anything to do with Davos, Switzerland, wasn't anything to do with the World Economic Forum. We were talking about the results overnight in Iowa. And when you ask people in the hallways of this conference, repeatedly, you ask them on the record, off the record, they almost brace. They don't want to discuss the prospect of the former president coming back into power.
You can hear them say, well, it's up to the Americans to choose who they will, and they will do what they will. But, you know, if you take a look at policies, we're not sure. Basically, no one wants to talk about it. But at the same time, why haven't people been dealing with this? Because he's been the front runner for quite a while. So I'm curious to see, as more people kind of put themselves out there, how they plan to adjust their business plans, how they plan to adjust their policies in response to something that's more than just a probability.
I think you've absolutely nailed it. The so-called globalists that will come to a forum like this one, worried about the future of globalization, the deglobalization, and the prospect of embracing the former president all over again and what that might mean for the future. It's amazing to me that they haven't prepared for it. It's amazing to me that we're waking up this week and having the same old conversation. The United States is a threat to globalization, regardless perhaps of who's in the White House. Yet at the same time, there's a total absence of conversation about European growth models and the failure of the last 10 years plus in places like Germany.
Well, that's why you turned it on its head when you hear from Christine Lagarde, the central banker, talking about what Trump would mean for Europe. But in the past 4 years, should Europe have been looking more introspectively about themselves, their energy dependence on Russia, their economic dependence on China, their defense dependence on the United States? We are still struggling to get NATO members to increase their defense budget by 2%. And rightly so at the Warsaw Security Forum, when a UK defense minister came out and said, what more will it take? There is a war on European soil. You have to increase. We cannot always rely on the Americans.
And the reason why I find this is interesting that we're talking about this is because where is the European AI push, given the fact that everyone's here talking about AI? I'm serious, because, you know, like everyone's talking, this is going to rule the world. Well, that's what we're talking about, Microsoft and Apple and Amazon and what they're going to do when they come out with earnings, because that has ruled the world. We could talk geopolitics all we want, but if money talks, that's what's really been the biggest speaker in the room.
What's the old saying? We've talked about it on Bloomberg Surveillance before. America innovates, China replicates. and Europe tries to regulate. Isn't that what's happening?
You could say
Isn't that what's happening across a whole range of things?
How do you change that?
I don't think it's going to change anytime soon based on attitudes on the continent that we see just repeatedly. Every single year we come here, it's exactly the same. I don't think the attitude has shifted on that front whatsoever.
Well, there is one individual here who I'm looking out for, because he is here, as he says, to read the riot act to the Davos elite, and that is the Heritage Foundation CEO. He said he was invited, he's avoided it for years, and he wants to come here and talk about where they've gone wrong.
Is he coming on with us?
Potentially.
We're trying to make that happen. OK, let's make this happen. Check out the markets going into earnings season on Wall Street. We're going to round that up all up for you in the next 24 hours or so. Goldman Sachs and Morgan Stanley just around the corner. Later this hour, I believe, Lisa. Going into that, equity futures negative here by 0.4%.
We have another incredible lineup. A lot of people who are really going to give a view forward, including Cantor Fitzgerald Chairman and Chief Executive Officer Howard Lutnick. Fantastic timing given the bank earnings we've been getting, as well as Nuveen CEO Jose Minaya. Intel's Pat Gelsinger, does he rule the world? Can he make the chips for the Amazons of the world and the Apples? And Chevron's Mike Wirth, especially given this backdrop. We were talking Ken Rogoff. Why are oil prices not responding to this geopolitical turmoil? I mean, we talk all these highfalutin comments. How do people respond to them? You give you some sort of stimulus, an event, and try to predict the market outcome. Good luck to you.
I was speaking to a pension fund manager a little bit earlier on this morning, and we were talking about doing business in America. And we tried to bring up the topic of US politics and who was in the White House. He talked about states. He talked about the ease of doing business in some states versus others. I said, name them. Reluctant to do so. Yeah. Then he mentioned Texas. Mike Wirth talked to him about doing business in California a little bit later.
Especially given the fact that I believe they are not refining anymore there. They're pulling back from certain Californian activities. Yeah, because of regulation. And there's sort of this question of, can states take the helm given the sort of national uncertainty?
Mike Wirth of Chevron coming up a little bit later on today. We've got to start this hour with this conversation on Iowa. The front runner for the Republican Party is running away with it very, very early on. Libby Cantrill joins us now, Managing Director and Head of Public Policy at PIMCO. Libby, great to get your perspective on all of this and your insights. Let's just start with the results overnight. Hardly shocking. Where do we go from here?
Yeah, hardly shocking. And good morning from very snowy New York. Yeah, so I mean, in many ways, I think that the big question, John, was, is this going to be a coronation of Donald Trump? He's obviously been, as you've mentioned, the clear front runner in polls now for months. And I think last night, honestly, sort of underscores the narrative that this is very much his nomination to lose. I mean, not only did he clear that 50%, which I think was something that was symbolically important for the Trump campaign, but in terms of the alternative to a Trump candidacy, there was no real clear alternative that emerged. Of course, Ron DeSantis came in second, a distant second, and then Nikki Haley a close third to that. But in terms of really, separating the field, separating that alternative and consolidating that sort of anti-Trump vote, if you will, that did not happen last night. So this was a very good night for former President Trump. And again, will likely just sort of corroborate that narrative that's in the market now, that this is very much Trump's nomination to lose.
Libby, you wrote one of the most interesting and quotable things in one of your notes recently. And Libby, I think about it all the time. You wrote, no, Jamie Dimon is not going to be president. No, Oprah Winfrey is not going to be president. And I asked you why, and you said because people are actually saying, well, maybe they'll swoop in and end up running. Can you speak a little bit about what you tell clients as they realize it is probably going to be another Donald Trump, Joe Biden matchup? What do you tell them about what a Donald Trump presidency would look like?
Yes, and I do, and we sort of say that flippantly, but we've gotten some questions, particularly from some of our, foreign clients who I think are a little bit befuddled by by sort of the American political situation, and potentially are saying that out of hope. Now, what we tell them is that just practically speaking, there will be no other kind of Democratic candidate. Joe Biden will be the Democratic nominee, and at this point, it does look like, now it's not for sure, and I would just say, as it relates to the Republican primary, New Hampshire is going to be critical. So if Donald Trump wins New Hampshire, I think this basically is over. But if he doesn't, and if Nikki Haley does win, then it's more of an open question. But really it does look like it's going to be sort of a 2020 redux. And in terms of, the policies, I think that if we saw a second Trump administration, it would be very similar to the first Trump administration. Lighter regulation, more tax cuts, those are things the market will like. But as you all have been mentioning, in terms of sort of the global landscape and the global posture, really much more of a retrenchment and, a much more protectionism, which as we know, as we saw in the first Trump administration, will keep the market on its toes. So, this is unusual in that we basically have, we would have basically two incumbents, a Joe Biden and a Donald Trump, running against each other. So in some ways, it's actually less uncertain because we know these gentlemen very well.
Yeah, and it's the gentleman, if you look at the polls, the Americans do not want to see going up head to head. But I want to ask you about the political timeline and really sit on New Hampshire. You have Nikki Haley sitting just behind the former president of New Hampshire. But now with DeSantis having a decent showing in Iowa, he's probably going to stick around. How does she chase the top and defend herself from the bottom?
Yeah, and I think that's exactly, that's why I think last night was such a good night for Donald Trump, because, again, there was no sort of clear second, no clear alternative to Trump. There was no sort of precipitating factor that really would lead to a consolidation of that vote. And as a result, as you say, DeSantis is likely going to stay in this potentially until South Carolina, and that is particularly bad for Nikki Haley. She has much more of a ground game and investment in New Hampshire, and so, and of course, as we know, this is a nuanced point, but it's important. It's an open primary in New Hampshire, so unaffiliated independent voters can vote in New Hampshire, not just Republicans. It's not a closed primary, so that will help her. So, I think we need to see something very definitive out of New Hampshire in terms of her momentum. And if we don't, again, I think this Republican nomination could be over before it really begins, and it would be Donald Trump again as the very likely nominee.
We also want to ask you about momentum in Washington, D.C. Are we going to be all going home to a government shutdown, or do you think Speaker Johnson can get this, prolonged, laddered approach done with a continuing resolution?
Yeah, it's the same menu, different waiter, if you will. It's the same dynamics, of course, that have selecting, former Speaker McCarthy back in the fall. It's the same reason why we needed another kind of temporary funding bill late last year. And again, as we've seen this movie before, it looks very much likely that we see another so-called continuing resolution until March 1st and then March 8th. Of course, Congress likes to complicate everything, so they've divided these two funding dates. But I think that bottom line here from kind of a market's perspective is that this is basically just noise, and it looks at this point like we will avoid a government shutdown yet again. But it looks very likely that we avoid a government shutdown. Now, come March, when I think the rubber will actually finally meet the road and they really need to pass these appropriations bills to fund the government through the end of fiscal year 24, that may be a different story. But at least for the foreseeable future, for this month, we probably have avoided a government shutdown yet again.
Hey, Libby, you're right. We've seen this movie quite a few times. Libby Cantrill there of PIMCO. The wonderful Libby Cantrill on the latest overnight in Iowa and the prospect of a government shutdown. I think as investors and market participants, Lisa, I think pretty much everyone has just been absolutely conditioned by seeing this story on repeat and seeing the same ending.
That they will eventually get a deal done. This is the reason why it's so hard. We talk about political dysfunction and we talk about just an inability to get things done. No one in markets cares. People are talking. Greg Jensen at Bridgewater, he told you, price to perfection, right?
Yeah.
We're dealing with something that markets are just looking past all of these things. And why shouldn't they? Because it hasn't come to fruition again and again in terms of a risk.
MH, that one's for you. Is it different this time?
Well, no, it's not different in the sense that the government's going to remain open. They are doing this laddered approach. I don't know why you don't just set one date for potentially the government shutdown. There's now 2 dates for potentially the government to shut down. As Libby said, they like to make things a little bit more confusing. My question is, does Speaker Johnson hold his gavel? Can he keep on to his job? Because McCarthy lost it with this same exact movie.
That's a big question. You know what TK would say? He'd look out into the distance, over into the mountains, and he would say, you can see Italy from here. And people would believe him.
You can't.
I would believe him. He would say it with such authority. He'd look out into the mountains,
trolling you.
Into the distance, and you can see Italy from here.
He speaks.
Coming up next, the governor of the South African Central Bank.
We don't think the rates will probably come back down to the levels we saw pre-COVID or pre this interest rate cycle, just because of the level of government debt and spending and the state of the economies across the world. So lower mortgages already, and we see that continuing going forward.
That was Charlie Nunn, the Lloyds Banking Group CEO, speaking to Francine Lacqua on his outlook for the UK economy and ultimately for rates. Big conversation about global rates here at Davos, Switzerland at the World Economic Forum. We were talking to Ken Rogoff at Harvard a little bit earlier this morning. Lisa, high for longer was his mantra, really pushing that one quite hard.
Basically saying 3.5% was probably the ending rate for this Fed after they start cutting, because we do get this soft landing, right, if we go with sort of consensus narrative, and then going up to 4 and 5% thereafter because of the deficit. No one's talking about the deficit anymore. It only matters when people start getting worried about
Greg Jensen of Bridgewater did talk about the deficit.
And did he actually say he's going to trade around it?
At some point we'll get to that wall, that moment. I was like, how helpful is that? Like, what does that day look like? I always ask that. What does that day look like when we start to really care about it?
That's why you've got to focus on the auctions. It's all the auctions.
Okay.
The auctions come out, they fail, and then everyone worries about something happening with the deficit.
You think it's that day we get like a proper failure?
Exactly. Or just, yes, a day where there's a true lack of buyers, or at least, just a feeling of frustration, a feeling of a lack of a bid. That's when you
That's the day the frog dies. But for now, it keeps boiling.
Well,
right, something
the
like
frog
that.
gets revived after that.
Something like
That's
that.
what happened before.
Equity futures on the S&P look like this. Let's take a look. So a little bit later this hour, 7:30, you'll get numbers from Goldman Sachs and Morgan Stanley. Shanali Basak at our Global HQ is going to break that down for you in New York City. Already had a ton of earnings, Lisa, on Friday. Get more to come later this morning.
And what we're looking for is just some sort of forward look, because we kind of got a bleak look from some of the CEOs. Citigroup really coming out with a kitchen sink, saying they were going to be cutting pretty dramatically. What do you hear from Morgan Stanley and then perhaps more importantly Goldman Sachs now that they're jettisoning some of their consumer-facing businesses at a time where the interest-bearing parts of the business really were the boon, frankly, for so many of the other banks?
We'll catch up with Ted Pick of Morgan Stanley a little bit later this week. We've got to catch up with one of my favourites right now, and he does not like the cold. It's Lesetja Kganyago, the Governor of the South African Reserve Bank. Governor, good afternoon. How are you?
I'm good, thanks. How are you?
Are you enjoying this weather?
Well, it happens this time of the year after coming from 38 degrees Celsius. This is quite something.
We saw you in Jackson Hole. It was pretty cold that morning as well. That was late August, and we still didn't get the nice weather for you. I want to pick up on the conversation we started in Jackson Hole, Wyoming, together, the three of us. We talk about the Federal Reserve front-loading interest rate hikes. And every time you and I catch up, I think it's worth reminding everybody who follows this story, the original front-loaders were not the Federal Reserve and the ECB and the Bank of England. The original front-loaders of monetary policy and interest rate hikes came from emerging markets. Yeah. First question, are you going to be the first to cut as well?
This is a discussion that fascinates me. Earlier on in your conversation, you were talking about a Harvard professor who was talking about interest rates being high for longer. And one of the things I always start my conversation with is, can we look and say how persistent has inflation is? Because that is the point of departure. And so far, inflation had actually been more persistent than we had initially thought. We have had a few readings where you had surprises. Just in my own country, in South Africa, we thought inflation was on a downward trajectory. It hit the low of 4.7, and before we knew it, it turned again before it went down. So inflation is more persistent. So if we want to know, want to look at which central banks are going to cut first, it's going to be those that have succeeded in bringing inflation down to target, or at the very least the ones with a lot more policy room. And you have seen that the early cutters this time around has also been the Latin American central banks that had very high real interest rates. They had that space, and that is what you should be looking at. In the case of South Africa, our real rates are not particularly high, and inflation has come down. It's within a target, but it is not quite where we would like to see it. And if we are to make any policy adjustments, we would have to see that inflation has declined to our anchor, which is 4.5%.
Has something changed, do you think? Has something changed domestically or in the international economy with regards to inflation since the pandemic?
Well, it's going to be an interesting call because I think that globally, central banks have underestimated the extent of the constraints that we face in the supply chains. Those have eased to an extent, But inflation is still stubbornly high, and that for it to be eventually conquered, we are going to have to keep rates higher for longer. I think that more importantly is that we are faced with something that, even in the case of South Africa, we hadn't seen. A public that is increasingly intolerant of high inflation. And that is what, for me, is a big change. And central banks, which in the earlier days were questioned about why are you so aggressive, why are you front-loading, they are now being criticized for not having done enough to rein in inflation.
We say a lot of times Jerome Powell is banker to the world, and I always feel bad for everybody else in the world who actually is doing policy for all of their specific countries. But is that the truth, that Jerome Powell, until he cuts rates, you won't get the all clear to cut rates because of the currency differential and because of the fear of devaluation?
A great central banker he is. He is the chairman of the Federal Reserve Bank of the United States, not the Federal Reserve of the world. And I have got no doubt that when he makes decisions, he and his colleagues make decisions, they make decisions based on the dynamics and the outlook of the United States economy. And that, for me, is very important. I think that in our case, yes, the U.S. is a big economy. We are a small, open economy. We watch what the U.S. Does, but we do not necessarily follow the U.S. in every move that they did. And case in point that Jonathan was raising was in 2021, when we saw that inflation was creeping up and there was a narrative amongst the advanced economies that it was a temporary phenomenon. We took a view that as emerging markets, been there before, seen it before, it's time that we act. And I'm glad that we acted at that time because we were able to start moving towards target much earlier than the advanced economy central banks.
The fact that you were an early sort of seer of what was going to come makes it really interesting to me that you're much more reluctant to signal cuts than over in the United States. And I'm wondering, do you agree with the Ken Rogoff view of the world, that essentially because of higher deficits and stickier inflation due to the supply chain disruptions that you were just talking about in response to John's question, that rates have to remain higher for a much longer period of time?
I would take it further. It's not just deficits. Look at the levels of public debt across the world. And these levels have got to be brought down. And one of the things that had happened historically was to almost inflate the debt away, allow inflation to erode the debt. But you have got a public that is intolerant of high inflation. So that is not an option that is actually available for the treasuries. Two, you have got treasuries globally that had been addicted to very cheap money. That era of cheap money is gone, and many treasuries are finding that they are borrowing at rates that are significantly higher than what they were borrowing at before the pandemic and during the pandemic. And third is that even in that space, what you are having is that you have got a whole generation of the public that had known only low inflation and low interest rates. And now inflation has risen and interest rates had to rise. And so you have got to rein in inflation because they are intolerant of inflation. And so you will see interest rates being higher for longer until the battle on the inflation front has been won.
We've got about a minute left with you, so let's do something provocative. You introduced the topic, though, not me. Sometimes governments make life harder for monetary policy officials. I believe there's a budget coming up, and I'm wondering domestically what you'll be looking for in that budget in South Africa.
Well, I like returning the favour. If the Minister of Finance was sitting here and you asked him what he expects of the central bank, he was going to say that he doesn't venture into that. So I don't venture into that. But they have pronounced...
Christine Lagarde does politics. Why not?
They have to... Well, you see, some of these central bankers might have been politicians before. I haven't been.
True.
So,
okay, carry on.
Yes, but I think that there had been a pronouncement from the South African National Treasury to set the fiscal policy on a sustainable path. I have got no reason to second guess them. I have got every reason that if they had made a commitment, they will meet that commitment. But fiscal policy is not going to be easy this year. There are more than 60 countries going for elections.
I know. It's a massive year for elections.
So it's not going to be easy.
That was the diplomatic response I expected. Governor, you're a good friend. It's good to catch up.
Good to be here.
Good to see you. Governor Lesetja Kganyago of South Africa. Earnings from Goldman Sachs just out. Let's head over to New York City and catch up with Bloomberg's Sonali Basak. Hey, Sonali.
Good morning, John. We have Goldman Sachs numbers out, and we have them beating on a number of key metrics here. We have them beating on revenue. We have them beating very handily on equities trading as well. They mixed on fixed income trading, but we know that the market was softer when it came to interest rates, currencies, commodities, credit. But, one thing we know about Goldman Sachs is they are pushing hard to win on financing. And there is where you see record numbers in their financing businesses when it comes to trading. When I tell you that they beat on equities, I'm telling you that they came in meaningfully above any other competitor here on Wall Street, both for the quarter and for the full year. When we see Morgan Stanley's number come out, it is very handily the case, potentially, that they have also beat Morgan Stanley on equity sales and trading figures as well. We have Morgan Stanley figures out as well, and I can tell you right now that Goldman has beat them once again for the quarter in equities trading. As we watch Morgan Stanley's numbers come across the wire as well, the numbers look strong. Also, John, you have Morgan Stanley's wealth management net revenue beating expectations as well. They, like Goldman Sachs, had one-time charges on other matters from Morgan Stanley. We know also that was a provision for legal expenses as well. But we are looking at strong numbers across the board. You are seeing the stocks reacting. Goldman now up about 0.6%. Morgan Stanley up by 1.6%. Remember, for Morgan Stanley, this was the final quarter of James Gorman's tenure, and now they are passing the reins over to Mr. Ted Pick.
Sonali, we are hearing from David Solomon, Goldman Sachs, in the release, calling 2024 the year of execution. What exactly is the year of execution?
You have to remember last year, throughout the year, that there was a lot of quarters where they had returns that were either muted, below expectations, and sometimes the worst they've seen in years. And what you're seeing now is them really turning around the story, not only beating on some key metrics here, Lisa. I will say they're the only bank that brought in more than $1 billion in advisory fees in a bad year for deals. Last year, they're bringing in more than $1 billion still in advisory fees. So you have them beating on the things that they are known for, trading, investment banking, and they are having their asset and wealth manager also beating expectations here. Remember, last year, they took a lot of charges tied to assets in that consumer unit, either that they were offloading or when it came to their historical principal investments. Remember, these are these balance sheet heavy investments for Goldman Sachs that they are trying to reduce reliance on. And in the most recent quarter, you saw them announce that they have really beat a lot of their fundraising expectations here and bring in more third-party money than they set out to do, as well as beating in net revenues at that asset and wealth manager. So they're showing progress. They still have that table with the one-time items that they've had the last couple quarters, but when you look at the hits that they've been taking, say tied to those historical investments, the scope of those losses are much, much lower than we've seen in prior quarters. They are being really prided here for being conservative on the onset. And even when it comes to their loan portfolios, the losses are starting to become more muted over time. And so David Solomon, on day one, really, or the beginning of the new year, is coming out and saying, this is Goldman's strategy. We have made some mistakes in consumer before, but we are moving on forward and focusing on the core business. And the core business is where you're seeing some wins.
Sonali, just zooming out as we parse through all the numbers, and we'll be analyzing this, and you'll be analyzing this in the hours to come and with all of the analyst calls. But we're seeing credit losses come in much lighter than previously expected. For Goldman Sachs, expected losses for credit, $577 million versus an estimate of $621. For Morgan Stanley, that number is even more shocking. It's $3 million versus $133 million. Do you get a sense that basically the banks are sounding an all clear on consumer and corporate creditworthiness at this point and saying the economy is better and people are going to pay their bills?
Lisa, you have to look at it in two terms here, because you did see the biggest banks, JP Morgan, Bank of America, on the charge-off rates come in a little higher and guide for the year that charge-off rates would start to increase through the year. For JP Morgan, that's less than 3.5%. And for Citigroup, that's between 3.5 and 4%. These are above pre-pandemic levels. But Goldman Sachs and Morgan Stanley, when you look at these provisions, they are weighted to the wealthier consumer, and they're weighted towards institutions. And you have not seen the type of stress in those markets that were initially expected from many investors here. It's yet to see how the year shakes out, but should rates start to come down, then that distress and that those losses on credit books could be less pronounced than initially expected, as you you know. And what's interesting is when you look at these numbers from these big investment banks, yes, we are seeing some weakness in underwriting fees still. In fact, Goldman had missed on both forms of underwriting here. However, you are seeing a jump back, which is a signal that perhaps people are ready to take on some more risk in credit markets, which bodes well for the likes of Goldman and Morgan Stanley that are ready to take on some risk after such muted provisions, to your point.
Let's get to the early moves in the pre-market off the back of some of these numbers. Goldman Sachs just a touch positive, up by 0.1%. Similar story for Morgan Stanley, positive here by about 0.6%. Shonali, that does it. We've had all the big earnings now from Morgan Stanley, from Goldman, from Citi, Bank of America, Wells, the likes of JP Morgan as well. Let's push forward and think about regulation. That's going to be a big feature of the conversation here at the World Economic Forum in Davos, Switzerland. We know they're unhappy about the prospect of higher capital requirements. Shonali, help us frame that situation right now. Where's that conversation heading?
It's headed in a direction that's getting quite ugly here because you have the banks pushing back very hard and saying to lawmakers and the Fed that not only will it constrain lending to have these capital requirements, but remember, they have operational risk targets that they have to potentially be beholden to, as well as other types of constraints on their trading activities, which they argue would be a pain to the Treasury market, for example, John, which we already know has seen some pains in recent months. So certainly they're fighting back hard. None of these bankers, we heard it from James Gorman himself, who was a staunch person to advocate against those rules, that they don't think that they're going to pass in this form. Another thing to consider is what does this look like heading into the election cycle? And if we have a different administration moving forward, do these banks have the same sort of difficult regulatory environments here that they've had in the last 4 years? Remember, it's not just capital constraints. These banks have faced record fines as well through agreements they've made, settlements they've made with different regulators. So certainly regulation will be a big part of this story. The trading books in particular are what I'm watching because a lot of these firms have made really large windfalls from trading activities in recent years, and that could be something that is more constrained when you see the likes of Jane Street and Citadel Securities also starting to rake in record numbers as these banks face more regulation.
Hey, Shonali, thank you. Great work, as always, breaking down the numbers on Wall Street. Morgan Stanley positive by, let's call it 2% in the pre-market. Looking at shares of the likes of Goldman Sachs positive by almost 1 full percentage point. Lisa, we'll talk about the earnings in just a moment. Let's talk about the regulatory regime. We're not on a one-way track here. The pendulum could swing the other way around. Given what happened in Iowa overnight, super early days, I know. But if you get a change in the White House, could we get a change of regime?
That's what we heard from Libby Cantrill, that what we can expect from a Donald Trump presidency 2.0 would be something similar to what we saw before. Lighter regulation, less taxation, which would be something that the banks would benefit in. Although it doesn't seem like the bankers are really backing Donald Trump. I think that that's sort of interesting. They're not. They're really actually backing Nikki Haley and other potential candidates, or they have been until this time.
I think everyone's hopeful that we can turn the volume down on U.S. politics. Isn't that the ultimate hope?
That's certainly the ultimate hope here, and I think that a lot of people are hoping for the same, which is the reason why everyone's surprised at the outcome that seemed an inevitability in the weeks leading up to this.
Without a doubt. Let's have a conversation about the earnings and not the politics. Gerard Cassidy joins us now, a large cap bank analyst at RBC Capital Markets. Gerard, great to touch base with you once again. Numbers from Morgan Stanley, from Goldman. Your first reaction?
Thank you, John. When you take a look at the numbers, they were very similar to what we saw on Friday with JP Morgan, Citi, and Bank of America's capital markets divisions. The investment banking numbers were the numbers that were better than expected in advisory, but generally ECM and DCM were numbers are on the light side relative to expectations. When you go into the trading side, similar to the others, we saw mixed results today. Equity trading was strong. FIC trading not so much as against expectations, and that was similar to what we saw on Friday. So overall, the quarters in capital markets were decent quarters. They weren't blowout great quarters, but they weren't real problems either. And the real key question, John, is what is the outlook for 2024?
And we heard that from the likes of JP Morgan, Citigroup, and Bank of America, and it wasn't that positive. Do you expect to hear the same kind of dash of cold water, at least attempt at it, from the CEOs of Morgan Stanley and Goldman Sachs?
Well, Lisa, it's really going to be market dependent. And it's interesting because, as you know, during volatile markets, trading does quite well. First quarter of 22 is a good example of that when, sadly, Russia invaded Ukraine. But it's not very good for investment banking results. Investment banking needs stability, steady markets. And now with the Fed looking like it's on pause for raising short-term interest rates, if we have some sort of pause or steadiness in the markets and rates don't go up higher from here, I think investment banking, particularly in the ECM and advisory business, could be the standouts in 2024. But then we may not see as strong trading numbers, particularly in equities.
Who's winning right now, Gerard, in the banking earnings race?
I would say that they're all clumped together, but you have to put, in terms of in the capital markets business, as you pointed out earlier in the program, Goldman Sachs is a dominant player in capital markets, as is JP Morgan. Those guys go neck and neck as number one and number two. And then you have, of course, Morgan Stanley, Bank of America, and Citi in the second, third, and fourth third, fourth, and fifth places. But I would say that there was no real standout where somebody was head and shoulders above the others. They all had decent numbers in the quarter.
Gerard, we're at the World Economic Forum in Davos, so we can push out the timeline a little bit and make some guesses about the future. So let's do that together. What do you think the banking industry is going to look like, Gerard, in the next 5 years? What are the kind of business lines that these companies will have to pull back from, ultimately because of the regulatory environment?
It's very interesting, John, because the Basel III comment period ends today. We should expect to see a number of comments coming from all the big banks pointing out why they should peel back the Basel III endgame regulations. I think the worst is priced in. But yes, there will be higher capital requirements, particularly within the capital markets business, in the operational risk area for the trading books in particular. But this is going to be interesting, John, when you have that longer term outlook. And I don't want to sound too Pollyannish here, but after this is finally said and done, which hopefully this year we'll get the final proposal, what is it going to look like for the next 5 years? Is this it? We think it might be. Imagine the banks having the opportunity to know that these are the final regulations for the next 5 years and they're not going to change. That's a very positive outcome. Granted, profitability will be lower because of higher capital, but just knowing what the goalpost is and not having it move is a positive.
Does it enable these CEOs to trot more heavily into private capital, which we've been talking about extensively, how much that's really taken a lot of the business out of the traditional bread and butter of banking, say, 20 years ago?
You're right, Lisa. It has made big inroads, particularly in the last 12 to 24 months. And certainly the banks will look to get more involved there. But we always have to be careful whenever we see rapid growth in credit extension, which is what's going on in the private capital area. You always got to be careful about that, because we know from history, whenever you see that in an economic real slowdown or recession, that comes back and gives you a hard time. So, yes, I think they'll get more involved in it. They'll do it more cautiously, but that is a line of business that the big banks will likely pursue over the next 12 to 24 months.
Hey, Gerard, great to catch up, sir. As always, Gerard Cassidy there of RBC Capital Markets. Numbers out from Goldman Sachs and Morgan Stanley in the last 10, 15 minutes or so. If you check out the moves in the pre-market, both stocks are in the green, both positive by something like 1 to 2% in the first 15 minutes. Not even Bramo responding to those numbers as they drop. The regulatory regime, to his point, let's think about what Gerard's just told us. If we do get a rush into private markets, is Moody's right to warn that you could get a race to the bottom, specifically in credit?
This has been something people have raised for a long time. Have we seen it yet? It's unclear, because there isn't a lot of transparency. We'll only know it when, who was it who said, was it really Warren Buffett, that when the tide rolls out, that's when you see who's swimming naked? I mean, there's sort of a sense of that, but the tide hasn't rolled out. So I guess we'll just have to see.
And we don't want to see anyone swimming naked either, let's face it.
You really had to go there.
No, I mean, you brought it up,
yeah.
So I had to comment.
Yeah, you know.
We don't.
It's a metaphor.
Come on. Coming up on the programme, Robin Vince, the President and CEO of BNY Mellon. That conversation just around the corner, live from Davos, Switzerland, your equity market on the S&P 500. Equity futures shaping up as follows, pulling back through most of this morning. We're negative here by 0.3%.
Resilience of not just the economies but also financial markets, to the geopolitical crises that are going on, to the rise in interest rates and the fight against inflation, has been remarkably strong. Whether that continues, I think we're all hopeful, and the overall sentiment for 2024 is positive.
Thank you.
The overall sentiment for 2023 was dreadful and 2023 was pretty decent. So 2024 is positive and we'll see how that turns out. That was James von Moltke there, the Deutsche Bank CFO. I know I sound super snarky, but you always get the feeling anything that's said at Davos kind of needs to be pushed back on because, as I said earlier, it's like a highlight reel of bad forecasts.
Well, it's been literally every forecast heading into every year. It's all been wrong. So if we're saying everything's going to get turned on its head, it's rather bleak because everyone seems pretty optimistic about 2024.
So less of the snark. Let's reflect on this. The last 12 months, I think it's absolutely phenomenal that we've seen the Federal Reserve go from 0 to 5.5%, from QE to QT, and unemployment is still below 4%, and GDP in the third quarter had something close to a 5 handle. So we should really be reflecting on the resilience of this economy and financial markets as well, for that matter. The fact that credit spreads are as tight as they are, you look every single morning, and equity markets are a whisker from all-time highs. That is certainly not where we thought we would be 12 months ago, and I would even say maybe even 6.
So I'm going to ask this to you. Have
Sure.
you heard any explanation for that really seems definitive? There's the resiliency. There's the fact that people got gobs of cash and hoarded it. There's the fact that companies got gobs of cash and hoarded it. But there's this big mystery. If rates stay at these elevated levels for a prolonged period of time, will we see the same resiliency or will things change? And I don't think that that question has really been answered in any kind of meaningful way.
Well, I think that's the hope, that we just go back to the old world. The rates are coming down. There's a great phrase in credit, and I'm sure you know it, survive until 25. Just get to 2025 and rates are coming back down, it's going to be OK.
As long as rates come back down, but we heard from Ken Rogoff, they're
Exactly.
probably not. And I think that's really one of the questions overhanging this sort of hope and dream of a soft landing.
Let's start the conversation here on resilience with Robin Vince, the President and CEO of BNY Mellon. Robin, good afternoon.
Good afternoon. It's great to be with you both here in sunny Davos.
Fantastic to catch up with you. I did not realise how old your bank was. What's the number now?
240 years old this year. This is our anniversary year.
So let's talk about resilience of your institution and the resilience of the last 12 months. How impressed have you been by that, both from an economics perspective and a markets perspective as well?
Impressed is the short answer. I think at the beginning of the year, you were both talking about this in your intro. 2023 was not the year that most people were predicting or expecting. And I think we saw, and certainly we saw, the fact that our clients were looking for a partner like us to be able to help them to navigate the ups and downs. And we have platforms that span the financial world, and being able to be resilient. We saw the importance of it. We saw it in the spring with asset and liability management. That actually does matter for a bank. And we saw it again through the course of the year with operational resilience. At the end of the day, you don't get to be 240 years old unless you are resilient, unless you're helping your clients to be resilient too.
It feels like a different moment for financial services. We saw some job cuts at BlackRock in the last week. Also saw an acquisition as well, to be fair. Saw some job cuts from you, I believe, in the last year. Was it 1,500?
We saw some job cuts earlier on last year. Look, we're always optimizing our workforce, but last year was also the year where we doubled our analyst intake of new graduates out of college, and we're going to double it again this year.
Are you happy with the size of the workforce at the moment?
Look, at the end of the day, our workforce is reflective of what it is that we're trying to do for our clients. There are tailwinds associated with more efficiency. AI is a good example of it. There are also counterforces, which is more business and more things that our clients are demanding of us. We launched new products last year, new products that have innovation at their core. We are focused on being able to extend buy-side trading. That's a platform we have. We've extended it to our clients. We launched a new platform in the form of Wove, which is for the wealth market. And so there are puts and takes in the headcount equation for sure.
I'm going to go to markets in 1 second, but since you're talking about employment, how much has the work-from-home model died?
Well, Lisa, our view on that is that we want to be flexible. We've got 3 pillars of strategy at BNY Mellon. We are wanting to be more for our clients, we're wanting to run our company better, but we also want to power our culture. And so what we've said to our people is that there are puts and takes with that. We need to give to them. Flexibility is an example. We also did a program called BK Shares last year, where we made every person at BNY Mellon a shareholder of the company. We've also improved our health benefits, mental health benefits, with premium-free healthcare. But we also ask more from our people, and we do ask them to be here at least 3 days a week. helping, driving our clients forward, contributing to pushing forward knowledge I just talked about our analyst program. You can't have new analysts in the building unless you have people to teach them.
So when you talk about income, one huge component of income for a lot of banks this year has been the fact that interest rates have been high and they don't have to pay as much interest to a lot of deposit accounts, and that's been a real tailwind for profitability. How much does that go away this year?
So NII was an important part of our growth last year, not the only part for sure, but we said at the beginning of the year that we expected 20% of NII increase, and we actually delivered more than that by the end of the year. We didn't change our guidance. It was important. We've got a lot of very sophisticated clients. We're largely an institutional firm, so our clients at the end of the day expect good pay of interest from us, and that's what we've delivered to them. Now, our prediction is that NII will soften this year. Most other banks have said similar things. And so that's where the fee and the innovation from our new products and services, that's really what will drive us forward. And that's what we said to the market when we announced earnings last week.
Last spring was tough for the banking industry. Can we reflect on that just for a moment? Precisely. For the specific banks that went under and struggled. And it felt like for a moment that maybe the financial system was under threat, and then we moved on really quickly. Any lessons from last year?
I think, Jonathan, there were a lot of lessons that we put into practice last year. Now, some of us have been practicing them for a while. You talked about resilience as we were starting off. Asset and liability management is a pretty core fundamental concept for a bank, and you have to do it really well. That's table stakes. We were reminded of that, but I wouldn't call it exactly a lesson, although it did depend who you were. And then as we went through the year, we had other examples of the importance of resiliency. Cyber's always on our mind, but so is innovation. We talk about AI a lot here at Davos this week, and AI is going to be important. We believe, we're excited about it, but at the end of the day, it needs to have guardrails. If we don't do those things well, like many things, it's going to be a problem. We view resilience as a commercial attribute, and our clients do too.
How excited are you about crypto? And I say this because you were the first major bank to offer custody services for crypto-related assets in 2022. So are you expanding that out? Are you kind of going to all of the parties that are being held here at Davos for the crypto space?
You know, I'm skipping the crypto parties, but what we have been doing...
That's the right answer.
100%.
Sounds like you've been having a lot of fun at them, but...
Absolutely not.
But what we've been focused on all along in the digital asset journey is the technology. Blockchain, we think, is going to be important for markets. Digital assets over time, tokenization, new assets being able to come into the mainstream financial system. Look, we touch 20% of all of the investable assets in the world. And so when there are ways to take assets that have not been easy to handle as part of the financial system and make them more mainstream in their operations, tokenization is an example of that, we're all for that.
Got a minute left. Work with me. Faith in humanity. I wonder how much faith in humanity you have. Every single time we make some kind of technological advancement, we just end up working more. Now, AI, if it's going to transform our working lives, do you think we're just more productive but do even more? Or are we actually going to work less?
Well, AI is going to change the nature of jobs, at least in our view. We've been deploying AI into our workforce and into our products. I'll give you two quick examples,
sure, please do.
Which is right on point. So first of all, we play a very important role in the US Treasury market, and that vantage point allows us to see things, but AI helps us to see them more clearly and provide insights to our clients, and our clients are very interested in that. And an example of just improving quality of life, exactly to your question, we've had AI started to do draft writing of some of our research reports. And it's not to replace the person who's writing it. They used to have to get up at 4 a.m. in order to write the report. Now they can get up at 5 because they've got a first draft courtesy of AI. I'd say that's an improvement.
And now they work until 9 or 10 p.m. at night. I mean, I'm joking. I'm joking. That's my lack of faith in humanity. I'm just so fearful that we'll make these advancements, but we'll all just work more.
I love it. 1 minute. Faith in humanity. Go.
Let's go.
I hear you. I hear you. I mean, it's going to happen for the people who are in positions where they can do that, and then everybody else lose their jobs.
Human nature is human nature, I guess. Robin, this was great. Really thoughtful stuff. Fantastic to catch up, sir. Thank you.
Great to be with both of you. Thanks.
Good to see you. Robin Vince there of BNY Mellon. Plenty still to come on this programme. Coming up, we'll catch up with Howard Lutnick, the Chairman and CEO of Cantor Fitzgerald. Also need to talk about financial markets with equity futures on the S&P 500. Looking a little something like this following earnings from Goldman Sachs and Morgan Stanley around about 25 minutes ago. Equity futures still negative on the S&P. Lisa, down about a third.
And we're definitely watching the bond market as well, with yields just inflected a ton touch higher, maybe looking at possibility that the Fed's not going to cut rates as much?
Up 6 basis points. More still to come on the politics as well. The results from Iowa. Bloomberg's Annmarie on a set with us here in Davos, Switzerland.
Under the hood, there is some indication that the labor market's a lot more balanced.
The labor market at some point, in our view, is going to have not necessarily, an incredible drop-off, but a more normalized progression.
We have the labor market issue. We have higher labor costs coming through the pipeline.
The market is probably going to have more of a pullback than what we've seen so far.
The markets are in a sort of choppy mode, probably stay that way for a while, especially for the next few weeks.
This is Bloomberg Surveillance, live from the World Economic Forum in Davos.
Live from Davos, Switzerland, for our audience worldwide at the World Economic Forum. Good afternoon. Good afternoon. This is Bloomberg Surveillance alongside Lisa Abramowicz. I'm Jonathan Ferro, together this week with Annmarie Hordern. We talked about Davos and the World Economic Forum being a highlight reel of people forecasting poorly. It's also a highlight reel of people complaining about the cold and sitting in the snow, which I've never made sense of. It makes no sense whatsoever. In a previous hour, we concluded that hour talking about resilience in the economy and in financial markets. The resilience that surprised us all. The fact that the Federal Reserve has gone from QE to QT, from record low interest rates to 5.5%, all in the space of something like 2 years, and yet here we are. Unemployment just south of 4%. GDP in the third quarter, something close to 5%. Equity markets a whisker from all-time highs and credit spreads incredibly tight. Of course, that resilience can lead to confidence, misplaced confidence, and maybe even complacency. Lisa, a word that I think that you're leaning on pretty hard as we kick off 2024 and our coverage of this forum. Can we turn to stability in 2024?
At a time where you have the election situation, which I think a lot of people are talking about here, where you have the potential for shocks, a lot of different conflicts that have been heating up in a dramatic way. The stability point, I think, is what stands out to me. They're saying, look, we can deal with high interest rates if they're stable. We can deal with stronger regulations if they're steady. This is a big if, right? On a year where everyone's talking about the potential volatility in all these elections and populism and misinformation, a whole host of other concerns that people are throwing out.
We can deal with politics if it's predictable. Annmarie, is it predictable this year?
Well, potentially following Iowa, it looks like Donald Trump is this individual that's going to carry the Republican Party, even though this is the election that Americans don't want. They don't want a rematch of Biden and Trump. But I've said it many times, and I'll say it again. These two are married politically, and that's like what it looks like we're going to get in November.
Results from Iowa. Could you extrapolate that out through the rest of the primaries this year?
Well, so the thing about Iowa is that we saw Ted Cruz win Iowa in 2016. Things can change in a caucus room. You don't just go stop by, put your name, decide who you want to vote and put it in a ballot box. You actually have a discussion with people. But the AP, CNN, CBS News within 30 minutes projected Trump won. This is before people even got in the caucus room to have this discussion. This infuriated the DeSantis camp. So put Iowa to the side. Why Trump wanted to win so big is because he wanted to make a statement to DeSantis and Haley. But New Hampshire is really what it's going to come down to.
Can we really take 100,000 people who voted in this thing because it was nothing? It was so cold outside that nobody wanted to go outside.
Annmarie's point, they didn't even count them.
I mean, but they didn't have to count them. That's my point. This was an inevitability. And I think that what really strikes me is the shock of the inevitability to some people, certainly internationally. And that's what we've heard here at Davos.
Well, to Libby Cantrill's point, this is going to be an election of two incumbents. Trump is an incumbent running in a primary with people who are chasing him, but he's an incumbent president and wants that spot back.
If you want to kill the conversation in Davos, Switzerland, ask someone on the record about the former president becoming the president again. No one wants to talk about it.
No.
Yet they all seem to be fearful of it. I understand why at a forum like this. If you are a globalist, if you believe in multilateralism, I understand why you might be fearful about the former president getting back control of the White House. The difficulty that we've reflected on over the last 2 hours, I think, is a really, really important topic that we need to push every single policymaker on. What is Europe going to do? Why is Europe still so highly dependent on what is happening in America and what's going to happen in the election this year?
even when it's on their doorstep, you look at one thing Europe has outsourced, and that's defense to the United States. There is a war in Europe, and you still have countries unable to reach their 2% target. A lot of conversations that are happening here. I just saw Secretary of State Antony Blinken, Jamie Dimon. They sat down with President Zelensky. He is here in a bid to try to get that ammunition and that aid to Ukraine, because at the moment it's stalled, not just in Washington, it is also stalled in Brussels.
I believe that Brian Moynihan of Bank of America also meeting with Zelensky a little bit later this week. We'll be catching up with Brian Moynihan later on, together with Morgan Stanley's Ted Pick. Plenty of coverage of financial services through the week in Davos, Switzerland. Let's turn to the price action on the S&P 500. Big morning for earnings from Goldman Sachs, from Morgan Stanley. Gramo, equity futures right now on the S&P lower by, let's call it, a third of 1%.
And people are trying to game out what they don't know, the unknown unknowns. But what we're looking at today is some of the CEOs and executives that really are shaping those decisions. Coming up, we have the CEO of Nuveen, Jose Minaya. We've got Adena Friedman, the CEO of NASDAQ. We also have Pat Gelsinger and Mike Wirth. But coming up right now, I've got to say, I'm so curious to hear what Howard Lutnick of Cantor Fitzgerald has to say about the road ahead in a potentially tumultuous year.
Let's get straight to it. Howard, good afternoon.
Good afternoon.
Hey, it's good to see you. You might have missed it. We were talking about resilience in the US economy and US financial markets. Typically, we always talk about risk and vulnerabilities. Can we start with resilience before we talk about risk? How impressed have you been by how resilient the economy and financial markets have been?
The economy's hanging tough. Inflation has not gone away. All young people, they think interest rates of zero are like normal. If you're 62 like me, you know that that's a manufactured nonsense. So here's my view. Steady Eddie. Okay, this concept, imagine the market is now calling for a 175 basis point cut by the Fed. Really? How about this? No way. No way at all. That is just a nonsense. If they get it wrong, they're going to get it wrong by staying higher for longer. And I think that is likely to occur.
If they stay where they are right now at about 5%, a little bit north of that, do you see capital markets activity coming back just because of that stability and that known?
Yeah, you just said it. Stability, it's fine. 5% is like a normal rate. I mean, if we have a $34 trillion deficit, $34 trillion, should it be at 2%? No, of course not. 5% sounds reasonable. I think the world can deal with it. But inflation is still too high and it's coming down. It's coming down, but it's not done. Come on. You go to the supermarket, you do all the things we all do. You got to be kidding me. Inflation is not in the rearview mirror, and therefore we're going to stay higher for longer. But it's not really higher. It's kind of here, maybe a little lower, sort of just to show off. But let's face it, 175 basis points, that, I think, is actually funny.
Well, OK. And that's what we heard from Ken Rogoff as well, that this seems like a pipe dream. That said, given that kind of backdrop of a soft landing and no Fed rate cuts this year, or very few of them, how much? Can you give some sort of quantity or some sort of qualification of how much IPOs, M&A, high-yield debt issuance could really pick up in an environment like that?
Well, look, so trading markets, for the banks, trading markets are back. I mean, zero interest rates were boring. So we own BGC Partners. It's the largest, most successful wholesale financial service company. And that business is on fire, right? Stock was up 80% last year, and it's still only trading 7.5 times earnings because our earnings are jumping so high, it's kind of sticking with it. So BGC doing well. So the banks are going to trade really well. They're going to have really good numbers all year long because now there's reasons to trade. I mean, let's face it, when interest rates are zero, you call the account, bring a pillow with you. It's just boring. But now, at least, you can sell A, buy B. So I think the banks are going to do really well. So you can see financial services are going to do really well. And we should talk a little bit about crypto, too, before we finish.
Oh, well, let's squeeze it in. What would you like to say?
So remember when gold ETFs started? They were very exciting in 2004. And it kind of stayed steady. There was all this hype that everyone was going to buy gold. And, oh, come on. So I think Bitcoin ran up. It's kind of going to stay steady. But when the halving comes, it's going to start to rally and grow. So Bitcoin, I think, will grow. And there's a company that I like called Tether. It's a stable coin. And, you know, I manage many of their assets. And Tether Holdings is the name of the group. And the group, I want to say it here with you, from what we've seen, and we did a lot of work, they have the money they say they had. In the last attestation, they said they had 86 billion of assets and 83 billion of liabilities. And I've seen a whole lot, and the firm has seen a whole lot. and they have the money. And so there's always been a lot of talk. Do they have it or not? So I'm with you guys saying we've seen it and they have it.
So spot Bitcoin ETF, do you think that's going to restore confidence to the whole sector given what we've seen take place in the last 12 months?
No, that doesn't have anything. That's just a way for Americans to buy it. Can I ask you a question?
Sure, please do.
Why are Americans having anything to do with Bitcoin anyway? Why do they have anything to do with stablecoin anyway? Well, I can give you money on Venmo, on PayPal. It's not an American thing. This is Americans just cocking around like buying Tesla stock. Okay?
Well, they're doing that plenty.
I know they do, but this is a speculative asset for us. But for countries like Argentina, Venezuela, Turkey, these crypto assets matter. Stable coins matter in those countries. Okay, they really do. It's a way to hold on to the dollar. So I think Tether's stablecoin in Argentina, in Venezuela, in Turkey. I mean, imagine you're in Turkey. You don't want to hold the Turkish lira. I mean, come on. It's going to go down 50% this year. You want to hold the dollar, and holding it in a token, right? Holding your dollar in a token is amazing. So I think that's why Tether's doing really well. You realize Tether has $95 billion in issuance? It's a huge amount.
Moving slightly away from crypto, I know that you've called CME Group the extraordinary monopoly in America and have tried to figure out ways to compete more directly. So how do you plan to take them on this year?
All right, so 2024, it's coming. It's called FMX. So remember, we are extraordinary in the markets for U.S. Treasuries. So we have an electronic marketplace for U.S. Treasuries. It's been growing market share 2% sequentially each quarter. So each quarter, last quarter was 25, so we'll probably do 27 this quarter. Just sequentially, quarter by quarter, we're going to partner with all the major banks. All the important banks are going to be partners with us because they want to create a competitor to that awesome CME, just to keep someone a little honest, a little competition. So FMX is coming. We expect to get CFTC full approvals. We're going to announce all our partners who are banks, which will really be more of who's not in than who is in. It'll be less exciting because everybody's going to be in. And we will roll out a competitor to the CME in 2024.
We'll have you back on with another pitch. I do want to get to this idea of fixed income trading. You were saying that this is good before you could have a pillow. Now it's actually exciting and fun, but it's been maybe a little too exciting. We saw FIC results come in from some of the banks a little lighter than people had previously expected. What's optimal in terms of yield swings, and what's good or what's bad for traders?
Well, traders like volatility. They like movement. It doesn't mean it's always going to go their way, but they're in the game of making transactions with their clients. And if interest rates were zero this year, and interest rates were zero next year, and interest rates are zero, whatever, I mean, who's calling who? It's kind of boring. So this market is excellent. Whether it goes up, it's not going to go up anymore, right? We know interest rates are not going up, and that would be horrific if they went up. The market would just vomit everywhere if that happened. So the question is, how much are they coming down? I think the answer is a little bit. Way less than people think, and I think you're going to see the banks do extremely well through this. 2024 is going to be really wonderful. You saw JP Morgan's results were great. Okay, Citi didn't have it as good, but, you know, Citi's always on the back end of things, but I think even they'll get it together, and I think you're going to see the banks do really, really well, and they're going to be a wonderful performing asset in 2024.
You could replace caffeine. I think we've got to do more morning breakfast meetings with Howard Lutnick.
Totally.
Great energy. Howard, it's good to see you.
Great to see you.
Thank you, buddy. Howard Lutnick there of Cantor Fitzgerald. Where do you want to start with that one, Bramo? Let's just start with rate cuts. The rate cuts that are priced in are laughable. It's a joke.
That's what everyone's saying. And yet the market's pricing it in. The market's saying we're not buying it and we're still doing this. So who's right? And this really is one of the key questions. And the question also is, can there be a soft landing and this type of rate cutting forecast? Because right now, that is the dissonance. There's a lot of optimism for people who are saying it's a pipe dream that we're going to get these potential rate cuts.
Ken Rogoff, Harvard, called it just that, a pipe dream on this programme. Coming up later this hour, the conversations will continue from Davos, Switzerland and the World Economic Forum. We'll catch up with Adena Friedman, the NASDAQ CEO, at 8:30 Eastern Time. Financial markets going into the opening bell about an hour and 16 minutes away, shaping up as follows on the S&P 500. Equity futures pulling back by, let's call it, a third of 1%. Yields are higher, up by 6 basis points and back to 4% on a 10-year. From Davos, Switzerland, this is Bloomberg.
It's not going to be as good as 2023, which was surprisingly good, but it's not going to be bad. Inflation's going to come down, soft landing, the 6 rate cuts. That's a pipe dream if we have a soft landing. That's not happening. We'll get 2 or 3.
That was Ken Rogoff, the Harvard professor and former IMF chief economist, earlier in the programme, saying it was a pipe dream to have a soft landing and the 6 rate cuts that are priced by this market. Bramo, he's not alone. We heard from Howard Lutnick just a moment ago, who said it was laughable what was priced into financial markets.
He just said it's not going to happen, so cut it out. And again, people are not listening. They're saying, look, what we see is commensurate with this type of rate cutting cycle. Who knows? I mean, we're talking about the soft landing and the political side of it, and how this is what the president wants.
Sure.
Well, can you have that Goldilocks scenario if you have rates staying where they are? And that's really the tension right now at this moment.
There's a ton of tension, that's for sure. Let's talk about the tension in financial markets. On the S&P 500, equity futures shaping up as follows. Earnings in the rearview mirror from Goldman Sachs and Morgan Stanley. Futures negative here by 0.4%. Yield up about 6 basis points. Let's call it 4% on a 10-year. The coverage of financial services continues. I'm pleased to say that joining us on set here in Davos, Switzerland, is Jose Minaya, the CEO of Nuveen. Jose, good morning.
Good morning. Thank you for having me.
Let's talk about the future of investing. And I want to start with this point. Whenever I talk about Nuveen, I don't think enough people realise that you are the #1 investor in farmland worldwide.
Yeah, I'd say natural resources in general, but farmland, we are by far the largest investor in it. And it's a conviction we took. We built that platform well over 10 years ago. Today, we're almost approximately 20 billion in AUM in that space. And it was one built for today's times, actually. It was one that we said, hey, inflation may show up someday. You may want less volatility in your portfolio. You may want more yield. And here we are today. We always say the hockey pucks come to us.
It's arrived. So let's talk about it a little bit more. The 60-40, things have changed a lot. Can you help me understand what the future of investing looks like? And perhaps we can reflect on something I talked about on a panel a little bit earlier this morning. You were in the room. Hugh Van Steenis, formerly of Morgan Stanley, wrote a fantastic piece in the Financial Times in the last few months. Originally, many years ago, he forecast that ultimately investing and investor flows would polarize into this ultimate barbell. And on the one side, it would be super passive, exchange-traded funds, cheap, convenient access to benchmark returns. On the other side, you'd have flows into specialized managers, alts, private markets, et cetera, et cetera. Have we arrived? Is that process complete, or is it changing?
I think it's always changing, but I think that's been going on for a while. And it made sense at the time. We've been going back to even 3-4 years ago, we were saying something that people understood academically. Again, you're going to have more volatility going forward. Returns are likely going to be lower in the next decade. And who knows, inflation may show up, and are you protected against it? And yield's going to be important. That, while people understood the academics of it, wasn't really an urgency. In a world where markets are doing this, you can kind of go out and say, I'm going to invest passively. And then, on the side, I'm going to look for these opportunistic exposures and just exposure on the alternative side. Today, that is more of an urgency. So you're seeing more and more creativity around solutions, products, innovation to try to get Main Street investors more access to alternatives to truly be more diversified.
What's the catch with financial creativity? Because when you say financial creativity, some people are saying, OK, so when are we going to actually see whether there are underwriting standards that are going down or there's some sort of pitfalls within these private markets that are less transparent and being replicated everywhere for higher fees?
Sure. Look, the catch is liquidity, right? That's what always is, again, people getting their capital locked up versus I can get it very cheaply in a very liquid way in an ETF, which is still a very viable vehicle. Yet, what is the value or the premium put on liquidity versus 10 years ago versus today? That additional return and alpha you get for taking your liquidity is very, very valuable today. So that's been the catch, but the perception of the risk behind liquidity or illiquidity, I think it's changed as well.
But how concerned are you? We think about sticky money, and we did see that real estate crisis, I should say, in the UK, within the past 2 years or so with respect to outflows and what happened with forced selling. We haven't really seen that forced selling yet for some of these funds that do cater to individuals. Are you worried about that at any point, that we are going to see that sort of pressure, that realization of losses that we haven't seen in certain private markets?
I really don't, because today what you've seen is the sophistication of investing in private markets and who's invested in private markets today, where it's very well balanced. Real estate, people love talking about real estate, and it's really around the issue that you're seeing in office. If you look at REITs today, 3% of their exposure is to office. The average institutional investor has maybe 10 to 15% exposure to office. They'll feel some pain there, But you know what? Things like life sciences, storage, logistics, they're doing fine. So again, it's an area of the sector where people are a lot more diversified than you would think, and the liquidity is going to be felt, or the lack of liquidity is going to be felt differently.
The ultimate question, I think, that leads to questions like these is, have we really paid the price for taking interest rates to 5.5% from zero? Do you think we have?
You know, I don't know the answer to that. I will tell you that more and more, we've been on the camp of a soft landing, going into 2024. More and more, I think that seems more likely the case. When I went to school, the idea of the Fed taking up rates this much and being where we are would have been unheard of. But we are in different times, that's for sure. I am a believer that we are going into a soft landing. I think that there's a lot of cash on the sidelines today that even at these rates is going to come back into the system as well. But the uncertainty will be present there for the rest of my career, right? The idea that whether it's a geopolitical issue, whether it's a policy mistake, the risk of this thing going the wrong way is there and will continue to be there into the foreseeable future.
So you caught the end of the panel that I did this morning on peak private markets, and I think at the very end I tried to introduce politics. You saw the reaction to the participants when I tried to talk about President Donald Trump returning as President Donald Trump. How are you thinking about elections in 2024? How meaningful are they to you?
Yeah, I take lessons from the previous elections, and I will tell you, I've been through many different cycles of Brexit discussions, the Trump election, the first time around. We all looked around and thought about putting in hedges what we would do differently. At the end of the day, we took a step back. I can't control elections. I can't control the markets per se. We can control the fundamentals and how we pick good management teams, good companies. So I've learned to kind of move away from that noise and really focus on the fundamentals of what we do well and anticipate volatility.
When you talk about politics, I have to also bring up China. Xi Jinping has sent the biggest coalition from China to Davos since 2017. A lot of investors are still saying it is an uninvestable nation. Where do you stand on that?
Well, they've been a big part of the global economy for some time. And yes, they are not open to global investments from the international community as, for example, investing in Switzerland or Germany for that matter. But I will tell you, they are still an important part of the globalized economy. People talk about globalization also around, we're going the opposite way. No, we're not. The pendulum swung a little too far. People are understanding the issues of value chains. It takes decades to change them. So I still think China is going to be a big part of the equation, albeit people have learned some lessons and are going to be a little careful in terms of how they interact or make investments around that. We started a policy some years back, let's go long with China short, and let's do it in places like Australia. You could do that for some time. I'm not too sure. Again, I think the world will continue to globalize.
Jose, this was great. Jose Minaya there of Nuveen. Jose, thank you.
Thank you.
Thank you very much. Plenty to think about here, Lisa. Particularly, I'll get my words out as I freeze to death, particularly on the elections in 2024 and the future of politics. I find it pretty amazing that we sit here and you listen to the Western investor who very casually talks about China being uninvestable. And we just move on straight afterwards, and we don't dig any deeper. It is stunning that we are looking at the world's second largest economy, and there are a group of very large investors, particularly in the West, in the United States, who have decided that China's capital markets is uninvestable. I think that's absolutely stunning.
It is stunning, except that when people have been burned for long enough, they don't want to get burned again. And the question is size. If you are a very large organization, you can't simply avoid the world's second biggest economy. And I think that that's really the struggle. It's not uninvestable. It's how do you invest at a time where there isn't policy certainty by any means. We talk about the uncertainty and the lack of stability in some of the political
Yeah,
sphere.
you're not going to get the policy certainty you want at this point. Also, pretty hilarious the last hour or so, just to hear people's reactions to what's priced into rate markets. The pushback has been pretty aggressive, hasn't it, so far this morning?
The pushback being you can't get your cake and eat it too. That basically you either have a soft landing and not very many rate cuts, or you have a hard landing and you have a whole host of rate cuts that are substantially more than what we're seeing right now priced into the market. You got to get one or the other, and that I don't think is something people are really grappling with.
That spread between what this market is looking for and what's implied by that median dot in the dot plot from the Federal Reserve has got to be reconciled somehow, one way or another, through this year. Coming up on the programme, we'll catch up with Adena Friedman of NASDAQ. From Davos, Switzerland this morning. Good morning. Your equity market on the S&P 500, slightly softer. There's a little bit of economic data just around the corner. We'll get to that with Mike McKee in just a moment. Live from Davos, Switzerland, at the World Economic Forum, alongside Annmarie Hordern and Lisa Abramowicz. I'm Jonathan Ferro. Let's get to the equity markets. Equity futures on the S&P 500 shaping up as follows. Equities look a little something like this. We're down by 0.4% on the S&P. On the NASDAQ 100, down by 0.5. The small caps, the Russell, just a little softer, down by 0.8. With that economic data, let's get to Mike McKee. Morning, Mike.
Good morning, John. Well, it's tertiary data, but it's what we've got today, so it may get some attention on Wall Street because there's a big drop in the Empire Manufacturing Survey covering mostly New York area. The headline goes to negative 43.7 from negative 14.5. New orders fall to negative 49.4 from negative 11.3. Those are the worst numbers since May of 2020, which of course was in the teeth of the pandemic. The worst numbers that anybody had gotten were in that month. Prices paid go up, however, 23.2 from 16.7. Employment drops negative 6.9 from negative 8.4. So basically, you look at the headline numbers, guys, and it says cut rates sooner. Look at the prices paid number, and it says not so fast, but they are big numbers in any case.
Mike McKee, let's talk about it a little bit more. How unusual is it to see swings like that in that data point?
Well, we have seen some big swings in the headline numbers, but nothing of this magnitude. The question is it just because of the weather, because of winter? What is going on here? Is this an outlier or not? We'll see when we get some of the additional numbers like Philly Fed coming up later this week.
Mike, just quickly here, are we seeing any patterns in terms of deterioration or negative surprises in some of the economic data that's been coming out that's more real time, since this is really the first read on January?
No, we really haven't yet. The numbers that we'll get tomorrow should be very interesting because we'll get the retail sales figures and we'll get industrial production. And those will give us an idea of how both sides of the economy are going at this point. And we'll see if there's any kind of real drop off or not.
Mike McKee, Michael, thank you on the latest data, which was pretty dreadful, to be honest. Lisa, wasn't it?
I mean, it was really shockingly dreadful, negative 43 as opposed to the expected negative 5. You're seeing a bit of a reaction in markets. But again, I mean, you just wonder, OK, did it just get cold and did people not go out? Or was there something specific and
Wasn't that what we said about certain data points in December as well?
Or there was a strike or
Sure.
this particular thing. I mean, it's just you can't really get too jazzed with one number, but people.
What was the North Star of last year? Jobless claims? Is that still the North Star? Is that the reliable indicator?
Was it that? Was it JOLTS? Was it some of these others? I mean, it sort of shifted on depending on the month.
JOLTS in and around 200k. More JOLTS data, or rather jobless claims data, coming this Thursday. Let's turn to the price action. Work through equities, bonds and foreign exchange. We'll get to stocks first. On the S&P 500, equity futures negative by 0.35%. On the NASDAQ, down by 0.4. We can turn to the bond market. Yields actually higher. Oh, morning. All through this morning. Higher again today by 6 basis points, 3.99.92. Bramo, we've kind of been here all month, haven't we? Just in and around 4% on a 10-year.
The tension between the buyers and the sellers in the bond market, with this idea that either you get a soft landing and you get higher rates, or you get a hard landing and you get lower rates, and people aren't willing to resolve that. And I think that's the tension that's keeping things stable for now.
You know you want to do the euro, so let's finish there. The euro against the dollar. Where is it, Bramo?
Probably, what, 108,
109.50, isn't it?
Well,
usually.
Where was it? Yeah. But now
sort
it's
of
like
109-ish.
Yeah, 109-ish. It's been
exciting
It doesn't
stuff.
really reflect any kind of massive divergence.
You're going to hear from Christine Lagarde, the ECB president, a lot this week. I just wonder if the tone has shifted since the December meeting, because what you heard from Christine Lagarde in that meeting was very different to the tone you got from Chairman Powell just 24 hours before her.
Although a lot of the ECB hawks have been out in full force, saying that there's going to be no rate hikes, or no rate cuts, and that people are way over their skis. So if she takes a similar tone, that'll be interesting.
A similar tone we've heard this morning on the Federal Reserve. Let's continue the conversation here in Davos, Switzerland. With us, I'm pleased to say, Adena Friedman, the Chair and CEO of NASDAQ. Adena, good afternoon.
It's great to be here.
It's good to see you. Let's talk about the transformation of your business. A lot of work is being done. I think a lot of our audience typically think of you as listings and exchange. Let's talk about what you're about to become. How are things changing?
Yeah, well, first of all, thank you. And obviously, our markets are our foundation, and they always will be, and they're an incredibly important part of our business. But what we've been able to do is really expand our relationships with our clients across liquidity. Like, how do we bring technology to markets all over the world to make it so that the liquidity in the markets is greater? How do we help our clients manage risk so that they can bring more liquidity to markets. Transparency in terms of helping corporates and investors find and manage their investment strategies. And then the third, of course, is integrity. And that's where we have our anti-financial crime suite and our regulatory reporting suite so that we really help the banks and brokers manage the integrity within the financial system. So we've gone all in across those three key pillars, and including our acquisition of Adenza last year. But we've been on this journey now for about 7 years.
Yeah, since 2017, you took over, and I believe you've had about a dozen acquisitions since then as you tried to broaden out. In the next 5 years, what proportion of your business do you think is going to be on the listing side? And what proportion do you think is going to come from some of the other fintech aspects that you've acquired and built out?
Well, we actually look at it in terms of kind of the trading business, and that's really between 70 and 75%. I mean, sorry, between 20 and 25% of our business today. And then we have our solutions businesses, which is all the data and the analytics, the software solutions, and that's actually between 70 and 75% of our business today. And with Adenza, that gets even a little bit higher. So we're really, really pleased that we have a really complete suite of solutions that we offer corporates, investors, banks, and other exchanges that help them navigate all the complexity that the capital markets and the financial system introduce.
You know, I've got to say, at Davos, I've been really struck by how much discussion there's around artificial intelligence and how people really are trying to figure out what to make of it. And Kristalina Georgieva of the IMF said that one of her big concerns is financial stability, that she is very concerned that people are not moving quickly enough to adapt the financial system to just how quickly some of these systematic learning programs can actually work. What are you doing about that? Is that sort of entering into any of your calculus?
Yeah, I mean, first of all, I think that the financial industry in many respects is on the forefront of a lot of technological innovation. On the other hand, it has a lot of regulation that underpins it. So it has to move with the speed of regulation in some cases. So what we try to do is bring as much innovation as we can to the solutions that help them manage the regulatory environment. How do we bring AI into the tools that help them manage down crime? How do we bring AI into markets, actually, to make it so they have a better experience in the markets? We have actually our first AI-driven order type that's coming out into our markets this quarter. And how do we help them as a more advanced technology provider so that they can adapt more quickly to all of the risks that are happening around them?
Can we build on AI just a little bit more and help me understand how we're going to confront what could be a new era of misinformation? How will we manage that when it looks like we're very, very close to producing a very lifelike video of you releasing your earnings a day ahead of time and people believing it? How close are we to that moment, and how concerned should we be about that?
I think AI brings opportunity and risk, and that is a major risk. And so I think thinking about the regulatory environment on the use of AI in trading decisions, in investing decisions, is an area that the regulators are really focused on, protecting against what we call those deep fakes that could provide misinformation to investors. We have some blunt instruments today that protect the markets, like our circuit breakers. We have single stock circuit breakers, market circuit breakers. But what you really want to do is prevent that type of deep fake from filtering into investment decisions. And I think that we don't have a honestly, we're still working on what is the answer to that. There's a regulatory framework, but it's really more of a technical question of how do you validate the videos. Like, you could actually use blockchain technology to do that, by the way. So how do you create almost like a validation mechanism? And I do actually think media has a big role to play in that.
We will, and I'm sure we have to confront some of that too. There was a very basic hack that we saw with the SEC account on Twitter only a week or so ago.
Which is ironic, considering that they're supposed to regulate it, and yet they were the ones that came out and said that they'd approved the Bitcoin ETF before it had happened.
Have you seen more of that, Adena, recently? Have you seen that threat materialize?
I would say that was the answer is not more than what you've seen. So whatever's happened has actually gone out into the media. That would probably be one of the few examples that we've seen. So not yet. I think that the effort, though, is you have to think about security every minute of every day. And it's not just the CISO's responsibility to manage security in your business. It's every person's responsibility to manage security in their business. So we do a ton of education. That was a wake-up call to remind yourself on dual-factor authentication for your Twitter accounts or X accounts or whatever social media accounts you have. There's a lot of self-help. But there's also, it's a collective action that's needed across companies to make sure you're maintaining security. That's obviously a huge area of focus for us.
It's fascinating that you're talking about the investing in technology on one side, and then people think of the NASDAQ index as so tech heavy and so dependent on a few of the major technological companies that have driven a lot of this innovation. Does it make the market more or less fragile to have a greater dominance of just a couple of key companies?
Well, I think that in general, the economy is moving towards having some really, really leading technological institutions that are really driving economic growth and prosperity, right? So we have to recognize that the indices tend to focus on and are really a reflection of where is the economy going and how is market cap evolving towards these larger technology companies. We also have to recognize that we're in a global competitive situation. It's not, you have to look at this in the context of maintaining the U.S. as a global technological powerhouse and enabling the businesses to grow and expand, to innovate, making sure the innovation ecosystem remains super robust, so you have new companies that are always coming in to challenge them, and then also allowing for every company to have good liquidity with strong investor protection. And that's kind of what we focus on, but I think that it's really what you see in the index is a reflection of the economy.
When you talk about good liquidity, we have seen a real drop-off in IPOs. It was a really weak year for that, and people have been talking about interest rates needed to come down before they can. Are you seeing that actually as being a reality, that this year is going to be more robust, or are companies realizing that it's better for them to finance themselves in private markets and just sort of do it that way in perpetuity?
I actually think that we have about 85 companies that have filed to go public on NASDAQ. So it means they're ready. They're in the SEC process, and they're just ready for the markets to be open. At the end of the day, it's really all about the investor. Are the investors ready to put risk capital to work? And also, investors predict the future. So if they believe that they're confident that we're not going to have higher rates, and we could and likely will have lower rates over time, then they can underwrite that, right? So they can actually put that into their model. A big unknown has become more known. And then inflation has come down, so the cost of doing business has come down. And that also, I think, gives them more confidence in being able to underwrite risk capital, which means more IPOs. So that's a long way of saying I do believe that there's the opportunity for more IPOs this year.
Do you think we're still struggling to reconcile some of the private market valuations of the last few years?
I think private markets and public markets are always going to have a little bit of a different orientation. I'm going to say it that way. So private investors take big risk, right? They take small bites early on in a company's life, but a lot of them. And the VC community has to kind of bet on the future, and they tend to make 10-year bets. So they're going to have a different view of value than a public investor, right? And so I do have to say, I think the private markets and public markets will never be perfectly synchronized. I think that, private investors are going to bet on a longer-term future, so they might be able to wait longer, be more patient to grow into the valuation they're paying. And public investors want to have more liquid options, and they look a little bit more on what's that valuation going to look like in 2 to 3 to 4 years, not 5 to 10 to 12 years.
You've made a bet of your own. Let's finish there. You mentioned Adenza, $10.5 billion bet, sophisticated, educated bet. Are we happy with where we're at now?
Yeah, we're really excited. So we closed the deal in November. We're integrating. The team is incredibly energized. The solutions are amazing. And when we are having conversations with the banks, we now can solve their most complex challenges, right? So across regulatory reporting, risk management, and anti-fin crime, those are the biggest challenges they face as operators. And we're very excited to be their partner.
Adena, this was great.
Great, thank you.
Thanks for catching up with us. Adena Friedman there of NASDAQ on the future. Lisa, I'm moving away. I think remodeling the company from the company that we all knew 10 years ago, exchanges, listings, all of that, to something different.
To a financial technology company that's more comprehensive. It kind of goes with the question that you were asking Jose Minaya about this idea of, are we moving to having a bite of indexed funds and then a bite of something else, and sort of how the financial market is getting more complicated and more rounded. And I think that that's, in terms of not only private markets, but also financial technology services. I just think it's an interesting moment for a lot of different firms and how to orchestrate that.
Well, you mentioned the concentration. Because of the concentration, there is a belief that you have to go elsewhere for opportunities for diversification, which is why you're seeing this real hunger, this push to go into private markets, which you just hear non-stop.
Yeah, which raises a lot of questions, and we'll have to explore them.
I'm with you. We'll explore some questions with Pat Gelsinger, the CEO of Intel. That conversation is coming up next, live from Davos, Switzerland. Good afternoon.
%60 of jobs in advanced economies over a foreseeable future are going to be impacted by artificial intelligence. If you're lucky, artificial intelligence will enhance your productivity, make your job more enjoyable, and very likely better paid. If you're unlucky, your job is
Such
gone.
ugly environs.
Kristalina Georgieva there, the IMF Managing Director, sitting down with Bloomberg's Lisa Abramowicz a little bit earlier on today. How did that go?
It was really interesting, actually. She had some wonderful words about Bloomberg. We'll talk about that another time. But I will say...
Did she actually have some wonderful words?
Oh, she was joking around about how artificial intelligence can make it sound like she was saying that, Bloomberg was terrible, and then proceeded to, continue to discuss that. But no, she was joking around, of course, obviously. My point was, I think it was really interesting to hear what she had to say about what Christine Lagarde had said about Donald Trump. And she said, American people could do whatever they want, they vote, etc. If you look at his policies, there might be some serious concerns. So that was some sort of undertone as people try to sift through the uncertainty of Donald Trump being president again.
What might those concerns be for the International Monetary Fund?
I think that a lot of the protectionist or the sort of more inward-looking, the tariffs, things of that nature, the less globalized kind of view on the world.
The question I would ask about that, have things changed under this administration from the previous administration? The rhetoric is different. The bedside manner is maybe what you might expect from the White House, but ultimately, has the policy changed?
Well, he hasn't gotten rid of NATO. I mean, there are some particular issues.
The tariffs are still there, though, right?
It is fair. I think it's a fair point. The question is, are we still on this trajectory of more nationalist types of measures?
We'll have more conversations about that through the week, no doubt. Just want to touch base with the price action just for you, going into the opening bell in about 42 minutes, something like that. Earnings from the big banks, Bramo, essentially behind us now. Goldman, Morgan Stanley this morning. Can we say there are any shockers? I can't think of any shockers.
There are no shockers. To me, the biggest shocker was Howard Lutnick coming on and saying, it's going to be an amazing year. Just ignore all of the negative talk. It's going to be a great year. So maybe that's more of what we can expect.
And the aggressive pushback against rate cut calls as well has just been a dominant theme of this morning.
Absolutely. People basically saying you either get a soft landing and very few rate cuts or a hard landing and many more rate cuts.
We've got a fantastic guest with us on set, not to talk about rate policy at the Federal Reserve. Pat Gelsinger, the CEO of Intel, does not want to do that. Pat, good afternoon. It's good to see you.
Good afternoon, Joe, Lisa. Great to be with you today.
No questions on Chairman Powell. No questions on Chairman Powell at all. Talk to me about deglobalization. How compatible is deglobalization with the chip industry in its modern form?
Well, ever since we started this journey of bringing the U.S. chips and the EU Chips Act to place, it was all about building resilient supply chains. And we said for something so critical, and I ask all the time, what aspect of your life is not becoming more digital? Well, everything is. And everything digital runs on semiconductors. And through COVID, we saw the fragility of our supply chains. We're one port, one island, and because of that, we said we need a balanced supply chain for the world. And that's what we're off to do, is to rebuild the Americas and the European supply chain for semiconductors. So, hey, we're all better off, right? We have better jobs, we have better national security, better economic, and we're ready for a turbulent world. And with 2 wars active today, and different countries, and different political and geopolitical concerns, this is critical for the future.
Let's talk about the CHIPS Act. Can you just walk our audience through, particularly the audience outside of the United States, what that is, how big it is, and whether you've actually received anything from it yet?
Yeah, so the CHIPS Act, $52 billion. Some of that was capital offset. Some of that was long-term R&D. And it was paralleled by the EU CHIPS Act, right? It was about 45 billion euros. So very similar constructs. And what it was saying, we never voted to get rid of this industry, this critical industry for the future, but Asian economies voted to get it. And as a result, we're no longer competitive in U.S. and in Europe. So let's create a leveling, and long-term incentives to invest in this industry. And that's what the CHIPS Act is doing. And, Commerce set up their department, DG Comp for the EU Commission is now underway. And we have projects in the U.S. and projects in Europe to take advantage of that. And they're in the latter stages, right? And as I say, boy, I'm ready. I'm building factories today. Let's go.
Can you quantify, though, to John's point, how much Intel is receiving from the CHIPS Act? Can you quantify how much cheaper it really would make manufacturing in the U.S. for you?
Well, what we've said is, and, industry analysis like the Semiconductor Industry Association in the U.S., similar studies done by BCG and others have said it's 30 to 40% cheaper to build in Asia. right? Because of, taxes, tariffs, incentives, labor, the supply chains. And the CHIPS Act is designed to close that gap. So if you're building a $20 billion facility, you're 30 to 40% uncompetitive without some of these economic capabilities being put in place. And that's what the U.S. and European CHIPS Act are doing, bringing those so that when we make enormous, and these facilities, and the one we're doing in Germany, is well over 30 billion euros. This is huge. And I can't be uncompetitive to that degree and expect to compete in the world market effectively.
There's a question when you talk about supply chains of the foundry that you're building and who's going to be building their chips with you, right? It's not just about your chips anymore. Have you had any real conversations with the Amazons of the world, with the Apples of the world, with NVIDIA about manufacturing some of their chips?
Yeah, we've had lots of conversations with them, and we've started to close design wins with different ones. And for the most part, it's not the industry practice for them to say their name because they already have relationships with others in that regard, and they somewhat view it as competitive intelligence as well. But as we've announced, we now have 3 major foundry customers for our most advanced process technology. We've now announced multiple advanced packaging customers as well. And my earnings call is next week, and we'll be updating on both of those as we come up on the earnings call. So we're making good, solid progress for industry engagement. We have tens of chips, test chips as they're called, that'll be going into the factories in the next few months here from different potential customers as well. I'll say momentum is building for us to become that Western foundry for the world.
The political attention this industry has gotten over the last few years has been phenomenal. I remember when Rex Tillerson got the job at the State Department, coming off the back of his work at Exxon, and there was a view that he was the ultimate diplomat because he had to deal with governments all around the world. And I now think of people in your industry as the ultimate diplomats. Have you had to become a politician over the last few years?
Well, my day job is running Intel. And, with that, making sure we rebuild our process leadership, our product engineering, rebuilding our customer relationships. But I've had to spend a lot more time in Brussels and in the Capitol Hill, right, on these topics than I certainly would have envisioned, right, when I took the job. But it's been fulfilling as well, because I think we've created the 2 most significant pieces of industrial policy since World War II. We've accomplished that in the last couple of years, and I think fundamentally we are rebuilding the supply chains of the West. I'm proud of that.
Well, you talk about Europe, and you mentioned building in the U.S., and you threw Europe in, and I kept wondering, where's the European CHIPS Act, right? How much cheaper is it to develop in the U.S. now than the Europe? How much does the Europe lack that competitive edge that it might have had?
Yeah, the gaps between U.S. and Asia and Europe and Asia are similar. Right, and this 30 to 40% is sort of a good thumb in the air, for that competitiveness. And we're not trying to say it's U.S. versus Europe. It's U.S. and Europe to be competitive with Asia. Because if we were here in 1990, 80% was built in U.S. and Europe. Now it's 20%.
But Europe doesn't have a CHIPS Act, and so I'm wondering.
Oh, it does.
Okay.
The EU CHIPS Act.
Does it commensurate your? Does it compensate
Absolutely.
you enough? Okay.
Absolutely. And we feel good with that. And our proposals for Poland and Germany, the 2 big projects that we've announced, will soon be going through the DG Comp process. I just met with Commissioner Vestager last week, and we discussed those proposals coming forward from Germany, bringing it forward, and Poland bringing it forward. So, we're expecting those to come to fruition quickly and get the big, Magdeburg project underway and the big Wrocław project underway. We're quite excited, and it builds on what we're doing already in Ireland, right, which is making good progress, and what we're already doing in Israel.
Pat, it's good to see you. Thanks for catching up with us.
Hey, thank you so much. Always a pleasure to be on Bloomberg.
Thank you very much. Pat Gelsinger there of Intel, the CEO of Intel and the ultimate politician, I guess, as well, which is what's happened to that industry over the last few years.
You have to be, because this is the new arms race. It is
Absolutely.
the chips race. It is the technological race, and it has to do very much with the hardware as well as the software.
So we're going to round up this programme, and I believe Manus Cranny is going to take you to the opening bell in the next hour on Bloomberg TV. In the next hour, though, we'll be back. We'll be catching up with Mike Wirth of Chevron, and we'll no doubt be talking about politics and policy, not in the White House, but from state to state, California to Texas.
Which we've seen in massive ways, talking about leaving California because of some practices that make it a lot less profitable. Interesting kind of dynamic. We've seen this with people moving, too.
Big time, big time. I wish I could, but I'm not sure I'm able to.
No,
I'd go for the taxes.
Yeah?
Yeah, without a doubt. Coming up on Bloomberg TV, Mike Wirth, CEO of Chevron. I think I just did. From Davos, Switzerland this afternoon. Good afternoon as we wrap up day one. More still to come throughout the day on Bloomberg TV and Bloomberg Radio.